Hi, thank you for joining us today for our virtual gold conference. Gold is trading at or near all-time highs, and the economic backdrop for gold has never looked better. Central banks continue to buy gold in record amounts, and in 2023, they acquired 25% of all gold production. So why are central banks buying? To protect their reserves against the falling US dollar and ever-increasing inflation. The Fed increased interest rates 11 times to get inflation under control, but the higher interest rates are now slowing the economy, and this is putting pressure on the Fed to cut rates. And lower interest rates will result in a lower US dollar, which will help carry the price of gold higher. Another factor which will carry gold higher are record debt levels. The federal debt is at $35 trillion and is growing by $1 trillion every 100 days. And the interest expense to service this debt is at $1 trillion annually. But in spite of this positive backdrop for gold, many gold equities are not reflecting the higher gold price. Where is the gold price going, and when will the gold stocks start to reflect the higher gold price? To answer these questions, we have assembled some amazing speakers, beginning with John Hathaway of Sprott Asset Management, followed by Rodrigo Borbosa of Awarm Minerals, David Iben of Kopernik Global, David Awarm of Sandstorm Gold, Rick Rule of Rule Media, Shaun Usmar of Triple Flag, and we conclude with international investor Jim Rogers. We would like to thank our corporate sponsor, Sprott Inc., a global leader in physical gold bullion trust and gold equity funds. Don't forget to subscribe to our channel, Bloor Street Capital, and also hit that notification button to be kept up to date on upcoming events. I want to thank you for being with us today, and I appreciate your support. Hi, John. Thank you very much for joining us today. How are things in the great state of Colorado?
They're great. Weather is very acceptable for my standards, and I'll probably play golf this afternoon, so all is good.
Yeah, I have to admit, Colorado is one of my favorite states. I love it in the wintertime, and I love it in the summertime. Beautiful place.
Yeah, just avoid it during mud season, which we've just gotten through.
So, John, you have been investing in gold and gold equities for many years now, and I want to get your views on that sector. But before we do so, I want to start with the economy. And I want to get your views on the economy and where it's going. This time last year, the economy was growing at 3% growth. In Q1 of this year, it came in at 1.6%. Then it was revised down to 1.3%. Where do you think we're heading now that we're at the end of Q2? Do you think we're approaching zero growth or maybe negative growth?
Yeah, I think what I would start with is that the investment consensus is positioned for a soft landing. And I would question that. I think the evidence is mounting that we're going to have a downturn that nobody, including the Fed, expects. And what can we point to? We could point to the rise in unemployment. The last two non-farm payrolls, we've seen an increase in unemployment, and I think we're now at 4%. We can point to weaker retail sales, and we can point to what I kind of get stuck on is the fact that the non-farm payroll survey, most of the job creation is in part-time jobs, it's in government, education, but they're not economic jobs. And lastly on that is that they're theoretical. It's not like somebody goes out and knocks on the door of a household or a business and says, what's the job picture? They have this birth-death ratio, which is a formula, theoretical, and so that job creation has exceeded and mostly explained the so-called job growth that we've seen over the last, let's say, 12 months. I don't have the exact numbers, but it's been huge number. But if you look at the household survey, where they actually go out and knock on doors, and they ask a family, what's going on, it diverges dramatically. And there are some, and you mentioned one name, Lacey Hunt, who's a highly respected economist and bond bull, that there will be substantial downward revisions, maybe later this summer. And I think he told me recently, early next year, that will move in the direction of the household survey, and that job creation that everyone believes has been taking place just isn't there. So that's maybe too much on jobs, but it's one of the big things where, and I would again say, the numbers come out of the Bureau of Labor Statistics, which is under the administration, and we're in election year, and wouldn't it be strange if they weren't fudging the numbers to make them look better for the incumbent administration? Now, I don't want to sound like tinfoil hat, but I just think that so much of the evidence suggests to me that the economic consensus is that Powell's going to stick a soft landing, and I'd take the under on that. I would say he's not going to. They're going to have egg on their face. They're going to have to hit the retro rockets on this so-called monetary stringency, and we're going to go into a rate cutting cycle at warp speed, probably in the next 6 months, and that will be probably very helpful for precious metals and hopefully mining stocks as well.
So I just want to summarize a few of the comments that you just made. You don't think we're going to hit a soft landing. It sounds like you think it's going to be a lot more aggressive, and the economy could be or will be going into a recession. Do I have that right?
Yes. Yeah, I think we'll have a recession. By the way, if there is a recession, and this is my take on what I'm seeing, and I can be as right or wrong as anyone, but I do think, as I said, the evidence is starting to mount in favor of a much weaker economy than the consensus expects. There are a lot of except call it rot under the surface, and a couple of things. One is regional banks are heavily invested in commercial real estate. Commercial real estate, we know, is a problem area. For a lot of different reasons, but the big one that most people would understand is that more and more people don't want to go to the office every day and don't need to, good and bad. The other domino that I think would be exposed big time in a recession is private equity, which is thought to be an alternative asset class. But all they're doing, I think these days, maybe at one time it was a very good idea, and businesses were better managed under the guise of a private equity group. But now so much money is flowing in, they're buying car washes and golf, driving ranges, and the multiples are ridiculous. And I read the other day that the Blackstone REIT does not submit valuations to outside appraisers, and they're getting calls for redemption, and they are basically funding those redemption requests with new money coming in. So that's the definition of a Ponzi scheme. Again, not my area of expertise, just stuff I've read, just anecdotal, but I think those two things, regional banks and private equity, could be exposed big time if the economy slips into a recession. And, is a global financial crisis worthy? Everyone says, who I've read about it, says, well, it's not systemic. When you hear that, you say, well, it is systemic. It could be. So are we headed to another episode like 2007, 2008? Who knows? But I think it's more likely than not that there's a lot of downside to the economic outlook. And this gets me to, I'm not even giving you a chance to ask questions. It's just one of the things that I think is missing for gold mining stocks is the comfort level that mainstream investors have with how they're positioned. And they're positioned, how are they positioned? They're positioned in, all things AI. They're positioned in a very few stocks that explain the movement of the S&P. And so it's a very crowded trade. I think if that crowded trade starts to unwind, people will look around and say, well, what else is there? And they will discover, in my opinion, they will discover the opportunities in precious metals mining stocks, which we can talk about, as we go along here. But that to me is the setup that I see for gold mining stocks and also for precious metals.
Yes, you raised some interesting comments about private equity and also private credit, and very reminiscent of 08, 09, when you had these mortgages, they were being valued by third-party valuation firms, and the same sort of things going on with these private equity funds.
Right.
So the values that are being placed on them are not the true values. They could be significantly lower.
Right. There needs to be price discovery, and I think you'll get that in an economic downturn.
So you made mention of the fact that you think the economy is slowing down and possibly going into a recession or in a recession. And I want to bring up the Fed. In 2021, the Fed made a serious policy error by saying that inflation was transitory. And then by March of 2022, they woke up to the fact that, oh my God, it's not. We got a serious problem here. We got to contain it. And then they lifted interest rates 11 times over the ensuing 16 months, okay? Do you think the Fed is making another policy error right now by not cutting rates faster?
The short answer is yes. I think they will be forced to become very aggressive in terms of monetary ease. Again, hit the retro rockets from where they're standing. I think they will be as surprised as the rest of the world that they've been restrictive too long. I remember I heard Tom Hainig, who was one of the members of the FOMC for many, many years from Kansas City, and he said he was the one dissenter over many years on the zero interest rate policy. And I met him a few years ago at a conference, and he said, deals that were done, financings that were done in a zero interest rate environment cannot survive a 5% interest rate environment. So the longer we are at 5%, let's say, the more damage there will be, because as you hit this wall of refinancings, which is another thing to talk about, the carry that was once very achievable at 0% or 1% or 2% is no longer makes sense. So the credit problems that could arise for the Fed overstaying this restrictive monetary stance would again contribute, in my opinion, to a deeper and more protracted recession than what anybody is expecting.
So the scenario that you are painting is very bullish for gold, okay? So we got a slowing economy, and because the Fed is behind the curve, they're going to be forced to cut interest rates drastically. That's going to result in a lower US dollar and a higher price of gold. So Let's look at the price of gold right now. It's trading at or near all-time highs. I believe it's up somewhere between 10 to 15% on the year. But the equities, we're not seeing, the equities are not participating in this move at all. They're trading at a big discount. Why do you think that is?
I think there are a couple reasons. One is that I don't think the average investor is paying any attention because they're very comfortable in their current investment program, which again, as I said earlier, is heavily weighted towards things that sort of approach the definition of a bubble. And so while there's been some recognition that the gold price is in record territory, the connection between what that means for earnings and cash flow of mining companies is just pretty much of an academic exercise and of little interest, as long as there's a comfort level with current investment positioning. So we have mining companies that are trading at historically cheap discounts to NAV. Big disconnect, not so much this year, but over the last 5 years, let's say, of the relationship of gold mining stocks to the gold price. So I think there's a huge mean reversion trade ahead of us, assuming gold prices stay at these levels, and then I could make an argument for why they could still even move higher. If and when people lose their degree of comfort and complacency with how they're currently positioned. I think that lies ahead, and that's why I would say we are at the cusp of a big move in mining stocks, even if the gold price stays where it is. I don't think that's going to be the case.
So one of the reasons why gold is trading at or near all-time highs is because of central banks around the world have been massive buyers. And in the last couple of years, I believe in 2022 and 2023, they acquired approximately 25% of all annual production according to the World Gold Council. And my question to you is, do you think because of this central bank buying that the central banks are creating like an artificial price in the price of gold? And in other words, if they weren't buying, the price of gold would be a lot lower. And maybe the equities are factoring in the real price of gold, which could be $1,600 to $1,800, depending on what names you look at.
Right. No, I think that's right. I mean, I think that, again, the reason central banks are buying, have been buying, is that we're seeing a shift in the way trade is taking place, particularly in the BRIC nations, the BRIC part of the world, that's China, Russia, Brazil, a lot of the emerging market economies, are trading among themselves, and they are not recycling trade surpluses into U.S. treasuries. They are recycling, first of all, the way the trade is taking place is that Saudi Arabia sells China oil. China pays in RMB, their currency. And the Saudis are now accepting Chinese currency, whereas before the Chinese would have had to acquire US dollars to pay for the oil. That's no longer taking place. And so so how does that work? What that means is that Saudis are accepting Chinese currency. China's starting to sell things to the Saudi Arabia that the Saudis pay for with the RMB that they've accumulated. And at the end of the day, maybe there's a trade surplus on the Saudi side, which was always used to be the case. And they would take that surplus and they would invest it in U.S. treasuries, and they would collect interest, and then that was the way it was done. What they're now doing now is they are asking the Chinese to settle up the surplus in gold. So that's the utility of gold for the BRIC countries. It's not happening for the U.S., it's not happening for Europe, but it's happening in the BRIC part of the world, which is about a third, I think, more than a third of the global landmass and probably a third of the global GDP. So a lot of trade is taking place that way. I think 20% of energy is now traded away from the U.S. dollar. So that's why central banks have been buying gold to recycle trade surplus, to settle trade deficits, surpluses with gold which is a neutral reserve asset, as opposed to U.S. dollars. That has implications down the road, which may not become apparent for a few years. But here we are issuing, the U.S., record amounts of U.S. treasuries because of the deficits we have. And the pool of capital that used to find U.S. treasuries useful because they could recycle trade surpluses into them is not doing that anymore. So we have supply of U.S. treasuries going up and demand outside the U.S. going down. And what that tells me, that is potentially a serious issue for credit markets, bond markets in particular, sovereign bond markets, at some point over the next, let's say, 2-3 years. So getting back to your original question, no, I don't think central bank buying, which is the big explanation for where the gold price is today at record highs, is a bubble. I think it's a reflection of reorientation of the global trading system, which has sustainable characteristics. It's not the algos in New York and London and Europe buying gold because it's going up and just piling into it, an unsustainable scenario. It's for reasons that gold is thought to be more useful and preferable than U.S. treasuries to play a part in trade among a big part of the world.
John, you touched on debt levels, and so I got to bring this up and get your views on this. But we have these record debt levels in the U.S. Federal debt's around $35 trillion. It's growing by $1 trillion every 100 days. These numbers are just mind-boggling when you think about it. Debt to GDP is around 125%. I believe that's at or close to an all-time record. But what are your thoughts on these debt levels? How do you think it gets resolved, and what does this ultimately mean for the gold price?
Well, there's some very smart economists who would take a different view than what a lot of people are saying about debt levels. They would say that, debt levels are high, but if the economy can grow, we can service the debt. But for that to be right, we have to have a growing economy. Where that argument falls apart is if we have an economic slowdown, because that makes it harder to service the debt. It also means that there will be more debt issued because you issue more debt in a recession. And so those are two opposing points of view on the issue that you just brought up. I would be of the school that would say, debt, I can understand the argument that debt levels are okay if we have a strong economy, that we're growing, and we can service the debt. But if the economy weakens, then that's a different story. And that creates, again, against what I said earlier, with foreign countries finding U.S. debt less and less useful to recycle trade surpluses, you've got a question on price discovery, and that would say maybe the 4.25% 10-year isn't the right level for U.S. debt. Maybe it should be 6%. Maybe it should be 7% if we have proper price discovery. And if that were to be right, think about what that would mean. The Fed is irrelevant. What it would mean is that, no matter what Powell thinks or says or does, it doesn't matter, because we don't have a viable long-term debt market, and everything will need to be financed on the short end. And they're already doing that. They're already shortening maturities because when they've tried to do these 7 to 10-year and maybe 30-year auctions, they have basically laid an egg. And so where we are today is that we're more and more forced into what you would think of as a banana republic, where we're financing everything on the short end. And that's the easiest part of the yield curve to control. And again, I think the gold market would see through that, and it would be very, very positive for the gold price.
John, there is a lot of economic uncertainty in the world right now. We have geopolitical risk over the Middle East and also the Ukraine. Within the U.S., we have a slowing economy. We have record high debt levels. We still have sticky inflation. We have an election coming up. What are you suggesting to investors? How do they position themselves in this current environment?
Well, I would suggest that they reposition themselves more in the direction of gold and related mining stocks. I have a chart which I'm just citing from memory, that the exposure to gold, and that would be gold and mining stocks, is the lowest it's been in 5 years among financial advisors in the United States. And so I would just say to think about that. And in the context, if you were to agree with some of the things I've said, why wouldn't you re-weight your exposure to gold, which is almost nothing, maybe re-weight it from 1%, which is about what it is, to maybe 2 or 3%. And I think people will do that if the economy falters the way I think it will. They'll be forced to do it, to rethink, because the investment positioning that they have now will not be working, and their clients will be asking them, what else should we be doing? So I think that's the sort of sequence that I would see for gold to move higher from where it is today, maybe 15, 20%. It's not crazy in my mind to think about $3,000 gold if we do have a recession. And if we have $3,000 gold, what does that mean for earnings of mining stocks that are already, as we've talked about, disconnected historically from the usual relationship in terms of valuation to the gold price? So that, to me, that means that many gold mining stocks, which to me are still depressed relative to their earnings power and relative to where the current gold price is, have significant upside over the next 12 months. And so I'm not sure that I'll have a lot of people listening to me right now, but that's what I think they should do, and that's what I think they will do if we head into a recession.
Well, John, that was a fascinating discussion, and I want to thank you very much for spending time with us today. You and your team are prolific writers on all things gold. If somebody would like to read some of your reports, where can they go?
Go to the Sprott website, which is Sprott.com. But we have a tremendous flow of information, not just from me, but from many other of our portfolio managers and analysts, that I think investors who might want to check out this line of reasoning would find very helpful.
Well, once again, John, thank you, and I look forward to our next conversation.
Thanks a lot. Enjoyed it.
Hi, I hope you're enjoying the conference. Just a reminder to subscribe to our channel, Bloor Street Capital. Give us a like and leave a comment. Thanks for your support. Hi, Rodrigo. Thank you very much for joining us today. How are things in Miami?
Hello, James. It's very nice to be here with you. Miami, again, is sunny and shy.
Yeah, I'm sure Miami's always great, isn't it?
Yeah, it's beautiful weather. It gets a little bit hot and humid now during the summer, but after September, it goes back to a very beautiful temperature.
So, Aura produced 236,000 gold equivalent ounces or GEOs in 2023, and that's going to grow to 450,000 ounces by the end of 2025. So that's huge growth in a relatively short period of time. And the three projects that are going to take you there are Elmes, Borborema, and also Matupa. And I want to discuss these, but before we do that, I want to have a discussion on your largest producing mine, Arizanzu. It's going to produce 100,000 gold equivalent ounces annually. It's a copper gold mine in Mexico. Can you just take us through this mine and provide us with a brief overview of it and how it's operating?
Yes, Aranzazu is a mine that's been operating over centuries in Mexico, in Zacatecas State, in Concha de Oro, the municipality. Awarm bought this mine over a decade ago, but faced a lot of challenge in terms of costs, production, recoveries, copper price went down. So when we started the turnaround project in Aura, when I joined the company in 2017, we reviewed the whole project. We focused on the first 5 years life of mine. So we rebuilt the feasibility study with the 5 years. We saw an opportunity to operate with a lower cash cost. And then we decided to restart. And after restarting, then reinvest the cash to expand life of mine. So just a brief numbers is we started this mine with 5 years life of mine 2018. We already expanded the capacity by 30%. We operated 6 years and now we have 8 years of life of mine. So we are now building life of mine as we are producing with a significantly lower cash cost compared to how our producing in the past.
And you touched on cash costs. Maybe expand on that a little bit more because the cash costs associated with this mine are relatively low.
Yes. When we decided to restart, we could see that one of the mistakes that was being done is pushing a lot of tons to the plant to increase the throughput. And with that, they were not grinding very well the minerals that the flotation we were losing a lot of recovery. So we reanalyzed, reassessed, and then we increased the milling time. We reduced the size of the grains, and that increased the flotation productivity. So we increased recoveries, James, from gold 55% to over 70%. It is a 50% improvement in gold recoveries. We also increased the recoveries from copper from 78 to 80% to over 90%. And then was combined with several initiatives to increase the efficiency at the mine and also the plant. And this efficiency is coming from a very strong team that we hired, we trained under the best culture under which they make those decisions that we believe it is more meritocratic, transparent. And then instead of production, it's just focus on cash flows with the highest standard of ESG locally. Actually, as a restart, James, we used Aranzazu as our place where we put all our efforts how to operate efficiently in one mine. And then after that, after several years training and learning, we are now rolling out all this expertise to the other mines, either Coena, Honduras, San Andres, and also the new ones that we are building. With that, we could reduce our cash costs by half compared to how we produced in the past.
So I want to move on now and discuss your growth projects. And the first one is Elmes. The last time we spoke, you were in the process of building this, and now it's up and operating. It's an open pit mine in Brazil. Why don't you just take us through this? Is it at full production? And was there any issues in getting there?
There's always issues, but we are very proud that we have accomplished our first greenfield product, not only on time, on budget, but also setting benchmarks, because we built almost in less than 15 months. And then when we started ramping up, that we were talking last year, we could ramp up almost in 5 months. So between building the project and going to full production, it was less than 2 years, setting new benchmarks in the sector as the first project that we are building. And we're very proud to have accomplished that in a project that already generating cash flows and returns with this current gold price above 100% per year, leveraged at 50%.
And one of the reasons why you were able to get this up and running on time and on budget was because of your technical team. Maybe you can just touch on that.
Yes, it's a combination, James, of a very strong technical team that you mentioned, and I'll talk about it later on. But also, our strategy was built making decisions that would get us as fast as possible to cash flow through projects that are easier to build, easier to operate. So the concept of the Almas project, it was already easy project, open pit, CIL, in an area that has full infrastructure, was already fully licensed. So all that helped us to achieve those goals. But we combined that, having a very strong team, very transparent relationship with all of them, very clear targets, meritocratic, bonus system, everything aligned to our shareholders and to the best of our employees and the community and the environment as well.
And what about exploration upside or expansion? Can you speak to this?
Yes, Almas, if I remind investors, initially when we acquired this project, it was projected to 2 million tons per year. But then we saw an opportunity because to produce from 70,000 ounces, 60,000 to 100,000 was just a marginal grade. There was not any already cash, and they were pushing too much cash into the implementation of the project. So we reduced the capex in the project from 2 million tons to 1.3 million tons. Then I would focus on higher grades that could leverage our returns to over 70% at the gold prices 3 years ago. Now it's over 100%. But then we made the plant flexible enough to be able to achieve 2 million tons as we are moving into the cash flows and doing some exploration to prove other sources of minerals that could go to the plant. So we are ready at this moment at full production and already thinking how to increase capacity by 15%. But our objective is during the next couple of years, 3 or 4 years, is if the exploration goes successful, which we believe we will, and then go and increase to 2 million tons per year. So start small, very efficient, high returns, and then from the cash flows, you expand to 2 million tons.
So the next project I want to ask about is Borbosa. This is really going to be the big driver behind your growth. It's currently under construction. It's going to be an open pit mine in Brazil. Take us through this project.
Yes, Borbosa, which we acquired in 2022, we revealed the feasibility study, we issued the feasibility study by mid last year and started construction right after. It's a very important project for Awarm because that will continue to build our way to achieve to 450,000 ounces of gold equivalent production by the year of 2025. And so a few examples that we can give to Borbosa and how important is this project, not only for where it is right now as on the feasibility study, but also the upsides that we can access after we achieve production is we are coming from a return at 40% and now going up to 75% in the current gold prices. NPV that was built in the feasibility study, the gold price $1,700 at $185 million of NPV. Now we are running at $440 million for NPV with the current gold prices. But on the feasibility study, James, what is interesting about this product, we used and we have to use 812,000 ounces of reserves, but the project has already 2 million ounces of resources. And the conversion of 2 million ounces to reserves, it's not very complicated in terms of exploration. It just requires us to move one road. It's just 6 kilometers, $6-7 million of investments. If we move this road, then we will convert significant part of the resources into the reserves. So I would say that we can more than double our reserves once we move the road, and then you can do the math, right? Already at $440 million of NPV. Imagine after we can more than double our reserves. So this project can be highly accretive in our portfolio after we start the production, and also we move the road.
And I'm sorry, when Borbosa is up and running and we're at full production, how many geos will it be producing annually?
Well, the first 4 years on average will be close to 80 to 85,000 ounces of gold equivalent, gold production, without the assumption that we might increase capacity. As we did with Almas, that we reduced and optimized the capex initially, we did the same with Borbosa. Now we are focused on 2 million tons per year as a project, but flexible enough to go over 3 million tons. As once we move the road, then we can increase capacity. So in the beginning, with only 2 million tons, we'll be around 85,000 ounces of gold production, but that can be significantly increased after we move the road and we execute on that.
And you touched on this a little bit, but this asset consists of 3 mining concessions. So there's huge upside for exploration. Maybe you can just take us through that and what your plans are in terms of exploration and also expansion.
Well, all around, we have a significant exploration potential, either near the mines that we are building or the ones that we are operating. For example, James, we have over 600,000 hectares of exploration rights that was underinvested in the past. Again, Aura is a company that has underinvested in the past in exploration. It didn't have a lot of cash flows to invest and understand the exploration potential. Only in the last 3 or 4 years that started generating us more robust cash flows, and then we started investing in exploration. And that, as you can see, few examples, in Aranzazu, we came from 5 years life of mine, operated 6 years, increased capacity by 30%, and now we have 8 years. Apoena, we had 3 years life of mine, we operated 7 years, and now we have 5 years. So we are building resource reserves as we can increase our production, and understanding that only recently we increased our capex, our exploration investment, to up to $35 million per year, coming from $5-6 million per year.
And under a best case scenario, when do you expect Borborema to go into production?
Well, our projections, which is, I wouldn't say best case, but realistic, is to start the ramping up of Borborema in the first quarter next year. We are already over 30% accomplished. Things are moving according to the plan, on time, on budget so far. And so continue with this rhythm. We'll be entering and starting production in first quarter next year, and then a commercial production by mid-second semester 2025.
And Rodrigo, the last asset I want to touch on, which is going to contribute to this 450,000 ounces in the latter part of 2025, is Matupa. It's another mine that's currently under construction in Brazil. It's also going to be an open pit. But just take us through this process. Where exactly does it stand, and when do you expect it to go into production?
Matupa, we are already finalizing the environmental license, which we expect to be granted in the next 4 to 8 weeks. And then from that, we already have the feasibility study and all the engineer to start the construction. Very interesting about Matupa. It's a smaller project compared to Borborema that will produce close to 60,000 ounces, but also expandable. As we did with Almas, we're doing it with Borborema. Our products, we like to start small, de-risk, start to capture the cash flows and expand. But only, for example, that we have in Matupa today, which seems small, it's 320,000 ounces of reserves, but we have many other targets that we are doing in exploration to significantly increase. Actually, we recently acquired 2 other mineral rights very close to Matupa that can also feed the plant and increase the resource reserves. And we believe we will more than double in the next 1 year or 2 in terms of resource reserves. But only with the reserves that we already have, the return is already over 40% internal rate of return, and the NPVs are creative. So we start small, build a product, and then we'll grow from that.
So I want to move on now and discuss your balance sheet and also your capital allocation plans. You have a lot going on. You do have 4 producing mines, but you also have 2 mines under construction. So maybe you can just tell us how much cash you have on hand and how you're going to allocate that cash in the coming year.
We finished the last quarter with over $210 million of cash. And fortunately, we've been able to, as we promised during the re-IPO in 2020, is to grow while we pay dividends and generate value for our shareholders in many different areas. So if you look what happened in the last 2 years, James, we combined, we had our EBITDA over $260 million, $270 million of EBITDA combined in 2 years. We acquired Borborema for $50 million. We invested in Almas, that's already in production. We paid $60 million of dividends. We also could build Almas with the $75 million, $50 million in exploration, and we finished the quarter with less than 0.7 times net debt to EBITDA, understanding that only this quarter that we are right now, we are increasing the gold price. Gold price in the first quarter was 2,050. Now we are at 2,300.
Rodrigo, I want to move on now and discuss valuation. Aura has a lot going for. You have 4 producing mines in very strong mining countries. You're cash flowing. You're paying out a big dividend, but yet you're trading at a big discount, especially compared to your comps. Why do you think that is?
Well, I think it's a combination of a few factors. I think one, we need to continue to grow. Our NAV is based on growth and development of our greenfield projects. And I think we need to prove to the market that we can build those projects efficiently. Alma is a very good case that we built in 15 months. We ramped up in 5. Borbosa is on the way. I think we need to advance more and show to the market that we are advancing on time and on budget. And that answers the execution front. There's also a lot to create value for shareholders in the exploration that we touched a little bit earlier, right? This company has underinvested in exploration, so we do not know much about the gold and copper that we have around the mine. So we just recently started to invest, and now we're being able to increase our resource reserves every year. And the other aspect that I would touch is the multiples that they are, the multiple of the sector and the companies that we are right now, which might range in 0.3, 0.4 times NAV, company that's producing 200, 300,000 ounces, we will increase, I think, NAV by the execution and growth, reaching the 400, 450,000 ounces of gold equivalent will give us a slight increase in our NAV. But to become important in the world and to be recognized by many of the major investors, we need to be above 500, 600, 700,000 ounces of production. So that's why we aim to continue to grow through M&A. We are constantly monitoring the market. If in one hand, we are significantly devaluated in terms of multiples, with the gold and copper price at the highest levels, which is interesting. Many other junior miners are even worse. So that gives us also a good opportunities to continue to grow through the M&As.
I guess one of the other things that comes to my mind is the importance of execution. And we talked about your technical team earlier, but you are building 2 mines. Do you have enough people? Do you have enough technical people to look after the construction of 2 mines?
Yes, we just finished building Almas, so we are using the same team that built Almas. We transferred to Borbosa. They are the ones that now are building Borbosa. With all the learnings, Almas with everything on time on budget, but we learned a lot. There was a lot of problems that we had to fix, so we might have different problems, but not the same problems in Borbosa. So we expect to be even more efficient in terms of construction compared to Almas. That team is highly efficient, highly motivated with the right incentives, but yet we are constantly growing, so we are hiring new people, hiring new technical. Now that's becoming more challenging as we grow. But on the other hand, which is interesting, Aura has although it's not very well known in the Canadian market, Aura is very well known in Brazil. It's a very strong brand. People want to work with us. We give them the right to make decisions. We give the right insights, highest ESG and safety standards, so they like to come with us. And Brazil, James, we have a Brazilian DNA, right? Brazil, it's a country that has a very strong university, very strong ecosystem for mining that Vale lead during the last decades. So the whole environment for mining in Brazil are very strong, but we should have been able to find highly qualified technicals and now even export to other countries.
No, you're right. Brazil has a very strong mining jurisdiction, and it adheres to the rule of laws, and that's very important when it comes to mining. And if you ever have a site visit, let me know. I want to come down there and check out your operations. But the last time we spoke, we also had a discussion on inflation, and that was impacting mining operations all over the world. But has inflation subdued now?
Yes, we've seen the inflation coming down in the last year, not significantly increasing. I think that the worst of the inflation was in the year end of 21, 22, a little bit early, like 23. We've been able to fight back the inflation, not 100% of the inflation, but a significant part. But yet you can see that the inflation impacting our cost. But fortunately, gold prices increased even higher. more than our cash costs in operations.
Rodrigo, as we wrap up, maybe you can summarize what investors should be looking out for in the coming months from Aura.
Well, James, we already proved in the last couple of years that we can operate and we can now actually build new mines efficiently. And now what we will see in the future, and I would invite all the investors to take a very close look, because we just passed the inflection of a growing production combined with higher gold prices and lower cash costs, because all the mines that we are building right now has a lower cash cost compared to what we have in the portfolio. So take an example of the last quarter, which is just the beginning of a very strong and long curve. We increased production by 30% compared to the first quarter of last year. That 30% increase generated over 45% increase in EBITDA, and that is assuming we had the gold price of $2,050 and copper price at $3 per pound. Imagine now, every quarter we will continue to grow compared to last year, give or take 68,000, 67,000, 70,000 gold equivalent ounce of production per quarter during this year. So every time you see the last 12 months, we are replacing last year that we didn't have alums, for example, and we had some challenges in Honduras. This year we won't have challenges in Honduras, and we have alums. So we'll see every last 12 months increasing in terms of production during this year. That is coming combined with the gold and copper price higher. But doesn't stop this year, James. We discussed about the Borbosa. So when Almas, the full year is already replacing the last year with Almas, which is 24, we start Borbosa. Borbosa starts production, not commercial production. We're ramping up by first quarter next year, and along the year it will increase production and declare commercial production. So we will continue to increase production in terms of gold, and also reducing the cost, while gold price, if you continue in this direction, can significantly boost our EBITDA. So I would invite everyone to take a look at that. We also just announced a new dividend. If you summarize a little bit, we announced 25 cents per share, which gives 8% of dividend yield in the last 12 months to our shareholder. 21 was 13.5, 22 and 23 was 6% each of the years. And now we are already at 8%, and now increasing production and margin. So we should take a careful look to our, we are very motivated to deliver the product on budget, while we keep our current operations very efficiently, not including eventual M&As.
Well, Rodrigo, that was a great overview, and I want to thank you very much for spending time with us today. It sounds like you and your team are going to be very busy in the coming months, so I wish you good luck on your various operations, and I look forward to speaking to you again for an update at some point in the future.
Thank you, James. It was a pleasure, and welcome to visit our operations while we are in Brazil.
I would love to. Once again, thank you. Hi, Dave. Thank you very much for joining us today. One of the things that makes investing so interesting is that it encapsulates so many different elements, including economics, geopolitics, and psychology. But I want to start with economics and the economy. Inflation is currently at 40-year highs, and the Fed has increased rates 11 times. I think I've lost count, but anyhow, in the past year, and they're trying to subdue inflation. And you and your team have done a lot of work on inflation. How do you think the Fed is responding to this current inflationary environment?
A couple of points. One, maybe I'm not the best person to ask because I'm sort of in the Ron Paul aspect in the Fed. I think we'd be better off without central banks. As far as the job they're doing, I guess it depends upon perspective. We, as 100% bottom-up investors, we don't try to guess the rate in the future, but we do pay attention to what is going on. Old school, we believe that printing money is by definition inflation, and CPI is one measure of the symptoms of inflation. So I don't think people should pay that much attention to CPI. It gets doctored and at least so much out of the equation. So that's one thing.
Printing money usually happens when there's too much debt and or fiscal difficulties. I think around the world you're seeing too much debt and fiscal difficulties. And so it's likely to see more debt creation, more debt monetization. If that's true, then inflation is with us for a long, long time to come. Where it goes into which assets and over which time is the interesting part of the equation, but it would be shocking if inflation were a thing of the past. I also will point out, I'm not that young anymore. CPI is just the one major inflation has gone up every year of my life. Yeah, it's all the way back before I was born, 1954 or whatever. Every year the CPI has gone up. So it's sort of endemic in the system, I think.
And you raised some very good points there about with the pandemic, that's when the money supply really increased. Maybe you can just speak to that.
Well, there's I guess two times. I say it's been constant for many years, but in 2008, it really blasted off. It went from, I think, 0.8 trillion to 4 trillion. So that was a five-fold increase there. Then with the pandemic, it doubled again, another 4 trillion. 4 trillion post the $1 trillion drawdown we both seen. So it went up 5 trillion. Now we're still at 8 trillion. So that's 8 trillion versus 0.8 trillion in 08. That is, to us, not a top-down thing. That is a fact. That's something that has happened. And watching it migrate into bonds and then into stocks and now into other things is an interesting phenomena, and I think creates challenges and opportunities.
And with increased money supply in printing, and you mentioned that the money supply has gone up. I believe you said it's doubled since the pandemic. Is that correct?
That's correct.
So would this imply the value of financial assets should decrease by a like amount?
To me, by definition, the value of the dollar has fallen in half, i.e., in general, things should have doubled in price. But as I mentioned, and Canelon points out, doubling doesn't happen right away. He talks about if you poured a bunch of water into the Mississippi River up in Minnesota, it takes time to get to St. Louis. It takes a lot more time to get down to New Orleans. It will flood over the low banks, but maybe not go over the high banks. And so I would say that over time, people should expect that to mean a doubling of prices, and over the 15 years, a tenfold increase in price. But I would suggest that history and logic suggest early on the money goes into financial assets. Later on, it starts to translate or migrate out of the financials into real assets. That's what I would expect. So I would not say that financial assets lose value. Bonds do, because there are claims on dollars that lose value. But I would suspect that stocks and a lot of real estate that are sort of financial, that are set by interest rates, will lag the rate of inflation. They will go up by less than inflation as their multiples shrink, whereas real assets, things that have lagged the last 15 years, but are not set by interest rates, will start to benefit from basic supply demand. 8 billion people trying to get fixed quantities of uranium, gold, oil, services, that sort of thing.
So I'm glad you brought that up, because I want to ask you now, how do we protect ourselves in this environment of runaway inflation? How do we protect our purchasing power? Do we just put it into GICs and hopefully we can make 4 or 5%?
Yeah, for much of the last 10 years, we were in Jim Grant's school of thought that bonds were return-free risk. We've been calling bonds, uninvestable for most people. That's no longer the case. 0% is the wrong interest rate. 5.5, call us neutral. We have no interest in investing at 5.5%. We think we can do much, much better, but we can no longer say that that's the wrong thing to do with one's money. What ought people do with their money is think, well, money supply is not scarce. They're printing more and more. We want to buy things that are needed and scarce. And so there's different ways to do that. We have no problem with what a lot of people are doing, buying the Googles and the Microsofts that are somewhat needed and scarce. We just believe that it's somewhat priced in already. They've had big moves. Everybody likes them. They're not underfollowed. People understand. What's exciting to us is that things that are also needed and scarce, copper that's needed for the windmills and the EVs, uranium that's needed for the carbon-free, pollution-free electricity, gold that, once again, may be needed as money now that we know that our people are starting to come around to the fact that fiat currencies are not so scarce. Those things are interesting. Natural gas is interesting as people are starting to realize that 200 years of creating a dependence on hydrocarbons wasn't going to go away in 3 years, and it probably won't be 20 years either. So things like that are selling at the same price they were 15 years ago before the increase in money supply, that's where we think people will make money. And I don't know if now is the best time to get into it, but not only are those things I just mentioned scarce and underinvested in and prone to do well in the future, but these things tend to be mispriced in the financial markets. People put big discounts on long-lived assets, where long-lived assets is exactly what you want to own if something is scarce, hard to find. And so if people are putting big discounts on the long-lived assets, you can buy big reserves of gold, copper, uranium, natural gas at huge discounts to what it sells at above the ground. That, we think, is where people ought to put their money. I will add to that in a world where lots of countries are doing lots of interesting things financially and monetarily, that people should diversify too. This is the wrong time to have all of one's money in one country or one industry or one currency, that sort of thing. So we suggest people buy stores of value across countries, across currencies, across management teams. So, and buy them like you can now at big discounts to what they're worth.
So you mentioned gold a couple of times. Why don't we start right there? You and your team are very bullish on gold right now. Why?
All right. We, as 100% bottom-up investors, we tend to be the mirror image of what the market likes. People say, it seems you like this and this and that. We say, no, because the market, being tens of millions of people that think thematically, crowds are famously erratic sometimes. When the crowd really loves something, that means they've not left a lot of bargains. We tend to not own much of that. When the crowd really doesn't like things, the stocks become cheap. There's also usually underinvestment in the area, which bodes well for the future. So we believe that things are starting to come around. People are starting to appreciate oil a little bit. They're starting to appreciate uranium a little bit. These are no longer at the bottom. We still like them. People do not like gold. Yeah, if there's one thing that the market really still doesn't like, it is gold. Even people that like gold do not like gold miners. The people that like gold miners a little bit will not own the guys that don't have the mine built yet. And so that's where the huge mispricings are. So your average person has less than 1% of their money in gold-related investments, and very little of that in the type of investments we have. So that is, we believe, the most mispriced area of the market right now, and that's why we like it so much.
And given that it's the most mispriced asset in the markets, what percent of your fund is allocated toward gold and gold equities?
We, as a discipline, never put more than 25% into any one industry, and we're right around 25% in mining equities, most of which is precious metals.
And when you say mining equities, does that include producers, developers, and explorcos?
It does, and it also includes the royalty companies. It does not include the uranium miners, which MSCI counts as energy.
So, Dave, I got to play devil's advocate here, and it just has to do with gold and the performance of gold. And you're talking about the complacency that currently exists within that market, and I would agree 100%. And pardon the pun, but has gold lost its luster, and is Bitcoin now the new gold?
It's an interesting question. I'm trying to write a commentary now on the whole concept of money. Yeah, the idea is in a dollar-based system, is it really gold versus Bitcoin, or is it stores of value versus dollars? And we suspect that, like the 1970s and like Argentina, like other times and places when people have lost confidence in the fiat currencies, we suspect people will come around to that. This is not, do we want gold versus Bitcoin versus copper versus stocks, versus agricultural land. I think it'll get to the point where people will say, we need to get out of dollars and yen and euros and yuan and buy something that can't be printed. And so if that's the case, I believe the last I've seen, people have less than 1% of their money in cryptocurrencies, and they have less than 1% of their money in gold, and they've got close to 100% of their money in dollar-based financial assets. I believe the competition is where the money is and what stores of value it's going to go into. So we won't argue against any of these stores of value. I think people need to buy quality assets that might hold their value. Now, crypto, we, like I say, have no problem with it. It's, the bulls are right on a lot of things. However, the bears are right on a lot of things too. So to say, if some of these dollars migrate into Bitcoin, it could go up many, many times. We agree. If somebody says, I should put a lot of my worth in cryptocurrency, then I have to say, well, do I want a lot of my net worth in something that we've seen that it can be hacked, it can be stolen, it can be confiscated by the governments. We've seen plenty of evidence on that. If people leave it out, it can be stolen. If they put it back into their wallet, then it can't, but then they can lose a password, or the drive could be destroyed. And then what happens during, outages of electricity or solar flares or this and that? And forget the last 15 years where the Fed has been honest with us about trying to destroy our value by 2% a year. Through most of history, central banks have promised they wouldn't print money, and then they did. So now somebody has promised me that there's an algorithm out there that's going to protect me from more Bitcoin being printed. Maybe that's honest, maybe it's not. So we view cryptocurrency as a very interesting speculation and not a place where people should store a lot of their net worth. Whereas gold is really boring, but it is thousands of years of having been an effective storage of net worth, and it is nobody's liability. It can't be defaulted on. It can't be hacked. It can be stolen, but it's been a good place to store value for lots of years. I feel much safer in that. And then if I want to speculate, in addition to Bitcoin, there's the levered ways to play gold.
Dave, I want to get your thoughts on, once again, the economy, but also the markets, the general markets. We started 2023 with turmoil in the regional banking sector. Silicon Valley Bank gone, Signature Bank gone, Credit Suisse was acquired by UBS. We still have the war in Ukraine. We also have turmoil going on in the Middle East, yet the S&P continues to hang in very well. The economy, the U.S. economy, is doing very well. Does this concern you at all, this exuberance that we currently see within the markets? And do you see fair value in the U.S. markets?
Yeah, it's an interesting question. I mean, what we see or don't see, it is rather remarkable that the market doesn't see anything to be worried about. It's sort of fascinating. But once again, we've been telling people, if for 40 years inflation has been moderating and interest rates have been dropping, then if people are trying to figure out what to do in a world where inflation has picked up again, interest rates are rising again, and geopolitical conflicts are rising and lots of turmoil, then people should maybe not spend a lot of time looking at the last 40 years. Maybe they should look at what preceded that. And the 1960s is when you had guns and money policy in the U.S., but I think a lot of the world, you had let's print money for social programs, and let's print money for the Vietnam War, let's print money for whatever. And that led to a boom in the stock market. You had the go-go years of in 66 and 68, and that was followed by the Nifty 50 in 72. And there was no fear. But underneath it, people were protesting in the streets, and there was lots of problems, lots of turmoil. And the markets weren't worried. They should have been worried. And so what happened after that, the Nifty 50 fell for 10 years. They fell, despite the fact that earnings were growing. The multiples went from too high to too low. And people went from not worried about the conflicts to very, very depressed by 1974, 75. It was a completely different world. The things to own as we transition out of that lax fiscal and monetary policy was oil, was gold, was emerging markets. And how interesting it is now that people are still willing to pay a fortune for growth stocks and a fortune for U.S. stocks, but they are still selling pretty cheaply commodity stocks, very cheaply some commodity stock, really cheaply emerging market stocks. History would suggest that rising interest rates is bad for long duration assets. Certainly the bond market has gotten smacked, but long duration stocks have held in very, very well. We think that's probably a mistake. We think the market looks at things too binary. They like to say, U.S. good, emerging markets bad. We think that's too simplistic. U.S. pretty good, emerging markets challenged. But emerging markets are most of the world in a lot of countries and numerous businesses. Certainly some of them are pretty good. A lot of them are benefiting from the transition into people wanting commodities, wanting other things. And so we believe that this binary thought process is taking the U.S. that deserves to sell at a premium and taking it to a super premium, and emerging markets that deserve to trade at a discount and taking them to a super discount. And so that creates opportunities.
You raise a lot of interesting points there, and I just want to clarify one. Do you think this point in history that we're living through is very much like the 1970s?
I think in a lot of ways, it's like 1970s. Even more so, though. I think when I came into the business in the early 80s, people were just dismayed about deficits of a couple $100 billion. It was I don't think could have gotten their hands around $2 trillion deficit. So this could be the 1970s on steroids, but we shall see.
But the one thing when we talk about debt, we've been talking about debt for like decades now, and many people say it's going to come home to roost at some point, right? But it doesn't, and life just continues on. And yet, the debt levels just keep growing and growing and growing, but yet the economy seems to do fine.
Well, it's interesting on a lot of levels. Yeah, are we doing fine? Probably the bulls were right that interest rates won't be allowed to meaningfully stay above the inflation rate. So they'll always be sort of 0 to negative real rates. And so maybe that helps things do fine. But fine for whom history would suggest it's better for people who own assets. It's not good for people that have to pay higher rents and higher services and higher everything else and don't have the ability to pay for it. Inequality, which a lot of people have always said, and it seems to be true, that printing money creates inequality. It creates class divide. If that creates problems, which it has to, then should multiples be as high as they are? Maybe not. There again, seems like the wrong time to be playing inflated multiples, and the wrong time to want all one's money in one country. It's probably better to diversify, because the future is unknown. But it's likely to be more volatile.
Dave, as we wrap up, I want to get your thoughts on where the markets might be going. And quite often when we think about the markets and what's driving them, there's always some unknown element. In 2023, maybe it was the regional banks. I think a lot of people are surprised at how well that whole situation recovered, and it really didn't amount to much. But if there was one element that you're concerned about in the coming year, what would it be?
Well, it is interesting. The regional banks, has the problem gone away? Yeah. Interest rates, I mean, the banks that have these duration problems, was there really only a couple of them, or are there more? And you read more and more about delinquencies on credit cards and autos and other things. Is this the time for credit spreads to be as low as they are? So we are simultaneously looking for the banks that do have solid fundamentals that are trading cheaply and may buy some of those. And at the other time, it would be shocking if no more banks come to the front with problems. So I would think 24, any time in history you have big moves up in interest rates like we've had, and we've never had it with 33 trillion of debt out there. I would say 24 should be a minefield. That people should be careful with. At the same time, if the Fed comes to rescue like they tend to do, all the more important to own the stores of value that we've talked about. Could be a very good year for them. It was a good decade in the 70s for stores of value.
Well, David, once again, that was a very fascinating and interesting conversation. And I want to thank you very much for spending time with us today. And I look forward to our next conversation.
Always great spending time with you. I enjoyed it. Thank you.
Did you know that every time you hit the subscribe button, your name goes into a draw to win $1 million? I'm just kidding. But if you do subscribe, it really helps us build our channel. Thank you for subscribing, and thanks for your support. Hi, David. Thank you very much for joining us today. How are things in Vancouver?
Very good. It's bright and sunny, so you can't complain.
Yeah, it's not often you see the sun out there.
Yeah, tell me about it.
But when it is, I think it's one of the nicest cities in North America.
Well, it's a beautiful city, and even though it rains a lot, I still love spending time outside here.
So, David, Sandstorm has 41 cash flowing assets, which are contributing to just over 80,000 gold equivalent ounces, or GEOs. And this will be growing to over 150,000 by 2029. And this will spin off huge amounts of cash flow. And I just want to touch on some of the assets which will be driving this growth. And the first one I want to touch on is Greenstone, which is an open pit mine in Northern Ontario. And it just recently achieved first gold in May of this year. Why don't you take us through this asset and how important it is, and what will it mean to Sandstorm when it's up and running?
Yeah, listen, this is going to be a great mine. It's been one of the ones that we've been eagerly anticipating from the Nomad acquisition that we made back in 2022. So it ends up becoming pretty nice, good cornerstone royalty for us as it gets into production. So yeah, like you said, just started first gold pour. I know that they've stockpiled a lot of ore there. It's going to be Canada's fourth largest gold mine in terms of ounces produced on an annual basis. It's been in that development pipeline for really quite some time. So it's great to really kind of finally see it hit that. It's designed exclusively, and the reserves are designed exclusively as open pit target. It's not too far outside of Thunder Bay in Northern Ontario. In a well-known mining district. So Equinox Gold, which is really Ross Beatty's current vehicle in the gold space, it's really going to be much by head and shoulders the largest project within that portfolio. So really a key producing asset in that group. It's pretty standard, Ontario Gold type of project. The mining that the stockpiling that they've done so far has reconciled well. So that's a big, key, important item. Now it's a matter of really making sure that they ramp up. Once they do ramp up, they're getting to that over 400,000 ounces per year production for the first 5 years. So that's great for us because we start seeing between 7,000 and 10,000 ounces per year accredited to us through that project. So we're happy to see it up and going, and we certainly wish Equinox the best of luck to getting the project up and going. The budget went well on this thing. The timeline went pretty well on this project as well too. So we're really pleased. It's looking to be kind of one of those outliers in that gold space, which has seen some big delays and time overruns and cost overruns. But this one has really hit the marks on that side.
And David, what's the mine life on Greenstone, and is there potential for upside through expansion or exploration?
Yeah, there's a good 14 years on that project in the open pit. Potentially even higher depending on where the gold price is there. But the geologic model for it really points well to a potential underground mine. If you take a look at really the long section of the project, the ore body plunges down over to the west, and it's really that's when you really start seeing a lot of size to it. Equinox is going through a lot of those economic studies right now, and the feasibility of really an underground project. If that continues on, we get full exposure to it, as always on these projects. So we just have to wait and see how the economics start unfolding for that. But there certainly is that potential for expanded open pit in a higher gold price scenario, which we're seeing right now today, but also some potential amazing underground production that could come up and continue to feed that mill for years to come beyond the existing mine life.
David, the second asset I want to touch on is Ivanhoe's Plant Reef mine in South Africa. Production of phase 1 will begin sometime next year, but the real growth will come from phase 2 and phase 3. Why don't you take us through this? And you were recently at site, so you can give us firsthand information.
Yeah, it was really an extraordinary site visit down in South Africa. The team is great there, very experienced. Many of those people that are building that mine on behalf of Ibenhoe have built everything that's really kind of in the DRC so far. So really a good team, well accomplished at building these mega projects. This project eventually is going to have 7 shafts associated with it. They are currently building and boring the largest shaft in all of South Africa, Shaft 2, which is going to have a more than 4 million, or actually closer to 8 million ton per year hoisting capacity on it. So really an extraordinary shaft, 100-meter tall head frame on it, 10-meter diameter. Really going to be a very impressive part. I was able to see a lot of that both at the bottom of the shaft and at the very top of it. So they're working on really primarily underground development work and building that mill right now. So they got a great team there. So they've done a focus, and they're going to continue to focus on development work for now. One of the amazing things that they've done is converted what was a previous vent shaft into a haulage shaft. So that boring has basically completed right now. They're just on the last steps of it, of shaft 3. That's going to have a huge hoisting capacity, 3 million tons per year as well too. So because they've decided to really kind of change the sequencing of some of their development, they may be able to kind of push towards this phase 2 production sooner rather than later. One of the items that we're eagerly anticipating towards the end of this year is an updated feasibility study, which will talk about really how they increase that phase 1. Phase 2, it will be a big increase. Currently, what that feasibility study is to start with phase 1, which is relatively modest at 800,000 tons per day. But once phase 2 comes online, you all of a sudden see almost 5 times as much overall annual production. Now, right now, that's slated till start 2028, 2029 at this point. But with this conversion of shaft 3, there may be that ability to have some sort of intermediate step there. When you talk about phase 3, which has been first really talked about in a more tangible way just over the last quarter, it's an even bigger jump up. It's basically duplicating what phase 2 provides in terms of tonnage by 2 more additional times. So phase 3, which they're really creating a PEA on that, or have created a PEA on that right now, takes it up to 10 million tons per annum on this project. So for us, it really is, I think, an extraordinary project. We love being attached to this asset. It really is going to be it will be, once it gets that phase 3, effectively the largest PGM and nickel producer in the world. We, of course, hold a gold stream off of this project, which is 30% of the gold that will get produced in this project. But it could operate for really decades to come, even at this very high production rate, if they are able to achieve the phase 3 production.
Well, that sounds quite impressive. And I want to put this into perspective. You said the head frame was 100 meters tall?
Yeah, head frame 100 meters tall. The shaft is going down almost 1,000 meters. So that's where they're gonna be hauling from almost 1,000 meters back up to surface. It's really an enormous project. The plan with the mill is just to really create one that's going to work well and just keep replicating that over and over again. So it's a very sound plan, very capable team by what has been the company that has the best history of building mega projects across the world. And they're our partner on this asset.
So we're going to go from one large mine to another one, and that's Antamina. It's the world's 3rd largest copper mine, and it was recently granted a license to increase the size of the tailings facility, and this will increase the mine life to 2036. Why don't you just provide an overview of this mine and what it's going to mean to Sandstorm?
Yeah, Antamina really is one of those remarkable mines in Peru. Really, still, I think, the lowest cost base metal producing mine in Peru at this point. They've been operating since the very, very early 2000s. It's a skarn deposit, produces copper and zinc as really primary products, but also has some moly associated with it, has some silver associated with it. Really, a lot of silver produced from that project. This has been operated as open pit for quite some time. One of the most efficient. It's been making a tremendous amount of money. A great team, primarily BHP and Glencore, Teck and Mitsubishi. They're the owners of this asset. It's high up, sits high up at around the mine. It sits between sort of 4,200 meters and 4,400 meters. Really a high altitude mine. They've gotten a permit now to extend their existing tailings deposit further again, which is great news. But they continue to look at this whole idea of long-term production. And even though they've just finished that process, they start to work at really what that next tailings expansion might be, either again at the existing one or potential new sites that they can utilize as well too. So this is something I think that most people had anticipated, certainly when we get the deal to acquire this royalty. We anticipated this had a high chance of happening as well too, just because of the high quality of that team that's associated and the high quality of the overall mine. One of the more important things that we're eagerly looking at is this idea of how a potential underground mine might look there. This is something that every year goes forward. It's not something that's going to happen in the next couple of years, but really as we start seeing that project mature, they're going to want to continue to target this amazing material that they find at depth. And they're going to continue looking at that and seeing how they can bring that material up and send it to that existing mill. I still do believe Antamina is one of these projects that still is generational in terms of timing, how long it's going to last for. It really, even though the current reserves take it to 2036, that's really just based on that tailings availability. As they continue to increase that availability, those reserves, I think, will go up, continually go up. And then as they start spending more time thinking about that underground potential that's there, we'll continue to see that expand. So it's one of those projects you always want to be attached to these types of assets because they're always going to surprise you to the upside in the future.
And I'm curious if you did you do a site visit to Antamina? And if so,
oh yeah, I've been to Antamina. It's really extraordinary. Not everybody could do those site visits because of the high altitude. It's really a pleasure to see projects like that. You know, I've known about this project my entire career, so getting a chance to go up and see one of these legendary mines, I always want to take advantage of it if it's available to me.
And I was going to ask if you were impacted by the altitude.
No, I generally tend, when you go up to a high altitude like that, you never know what you're going to get. I've been lucky every time I've been able to handle it. And I think one of the things truly is that I do get so excited about these projects. I don't know if when you do get a chance to see something up at high altitude, maybe if I wasn't so excited, maybe I wouldn't be able to handle it as well. But I feel I always get spurred on by that.
So let's move on, and we have to discuss Hamadan. This is the largest asset in your portfolio. It represents approximately 11% of NAV. You were recently in Turkey. You've been traveling all over the world this year, but give us the latest on Hamadan, and when can we expect a construction decision?
Yeah, listen, as always, it's a real pleasure to go see that project. It really, it's extraordinary to see it. It's extraordinary to look at the drill core. They've started actually The operator there has started making progress on some of the early works. So for the first time, I started seeing preparation works for really getting the project built. Of course, it's really permitted. It has its EIA. It has its forestry permit for what it's doing. What's been happening over the last year, and has been a lot of optimizations to the feasibility. Of course, with the new operator in the project, the SSR, they're looking to put their own stamp and really implement a team. The operating entity is called Artmin. That's the Turkish company that actually owns it. And Horizon gets their Horizon Copper, which is where we have our gold stream coming off of. It's attached. It's one of the owners of those assets, as is Lydia Maiden-Chilic, and as is SSR, who is the operator of the project. So they've been optimizing it. They've been really kind of creating a timeline for it, starting some of these early works projects. It still needs to undergo project financing, and we still have to really kind of see what the timeline is going to be. Of course, the operator has had some problems in Turkey with their Çöpler mine. We're still understanding what the fallout of that is and how that might affect it. Currently, we still have the permits on the project. It is ready to really go into that construction phase, but we do have to go finalize some of the project financing on it. In the meantime, though, we continue to have the experts work on it, the design work happen on it. We continue on the early works. So there are items moving forward on this. We still, we push back the original production from 2027 to 2028. We'll have to really kind of see how that, as it moves into that full construction phase and get through the project financing phase, we need to be able to understand what that timeline is. But in the meantime, that asset really continues to impress. As we see gold prices and copper prices rise, the economics just get more and more amazing on this project. Once you're talking about 13-gram type of material, 13-gram gold equivalent coming to surface, being able to mine that at where we have copper prices today, where we have gold prices today, that just gets amazing. So the mine's still there, the deposit's still there. We have a community that's really hopeful, that really wants to see the project up and going. We are really hopeful to see this project up and going, but those economics preserve themselves, even if there is a delay getting there.
So one of the elements that I really enjoy most about royalties and the whole model of royalties is optionality. And one of the assets in your portfolio that really fits this category is Mara. It's a brownfield asset. It's owned by Glencore. And when you acquired this royalty, it was in 2015 and gold was at $1,200. And now, of course, gold's at $2,400. But take us through this asset and where it is in the stage of development.
Yeah, listen, again, this was another part of that amazing Yamana deal that we did in 2015, and which included Chapada, Cerro Moro. This was a little bit of an add-on deal. I know Yamana at the time was looking for a little bit more of an upfront payment. $12.5 million is what it was. And what that bought us was an option at our choice to purchase a 20% gold stream at a 30% of the spot price going forward of that Mara project at the time. All right, that was Agua Rica at the time. Yeah, at the time, Yamana owned 100% of the project. They were the only ones in there, but subsequent, in fact, relatively quickly after we did that deal, Glencore started getting involved. Newmont was involved. Since that time, Glencore's accumulated all of these pieces. Now they own 100% of it. They've merged it with Alumbrera. So Agua Rica, which was at its own a greenfield project, which would have needed a mill, it would have needed really kind of its own facilities at a port to be able to really export the concentrate. It would have had its own mine. Now it's all combined with an existing permitted used infrastructure of Alumbrera, which is now this Mara project under Glencore. And of course, Glencore, one of the largest mining companies in the world, they're highly motivated to get this project up and running. because they don't have ore at Alumbrera anymore. If they don't start utilizing that Alumbrera infrastructure, which is a mill, fully sized mill, tailings facility, and a pipeline, a concentrate pipeline that goes down to the port, which is a really valuable asset, as we know here in South American operations. If they don't utilize those things soon, they're going to be looking to close it down by the Argentinian government, which is going to incur an enormous cost to them. Glencore doesn't want to see that happen. They want to be able to continue to use this. Agua Rica, the Mara project now, as it sits, has got a 28-year mine life with potential beyond that. Glencore is going through and doing a feasibility study. There's the potential that they might give the go-ahead for this project as early as 2026. That's when we actually have that ability to take that option. At that time, $225 million upfront payment we'd have to make, but we would make that in stages as Glencore does spending on the construction of this project. So it would probably happen over 2 years. For us, this would be one of those remarkable projects because it's basically priced at $1,400 gold. We've had gold prices that are more than $1,000, over $1,000 above that subsequent to that. In the next 2 years, when we actually have to make that option, almost certainly it's going to be above that. If you were to price that in today's dollars, if you were to sell that stream today, you could probably sell it for $400 or more because it's such a high quality project. And of course, you have Glencore as the operator of this asset. So if we were not to do anything else in the portfolio, if we weren't to buy anything in the meantime between now, call it 2026 or 2027 or 2028, when the project starts producing, we would still continue to have, that would be certainly be the most accretive deal that can be found out in the industry today, and would be a great deal for us and provide us with a tremendous amount of growth. So that's something that we're really interested in, and we're really happy that we took that risk early on to secure an option on really what's going to end up becoming one of the best and most important new copper projects to be built over the next 5 years.
And I just want to clarify one thing. You said if you could sell it today, you said $400, but do you mean $400 million?
Yeah, sorry, $400 million. Yeah, where we will end up, our option is for $225 million.
Right. So huge upside there. David, I want to discuss your balance sheet now and capital allocation. And with the increase in the gold price, Sandstorm is throwing off a lot of cash flow. It's provided Sandstorm with a great deal of financial flexibility. And your objective, since you took on all this debt in 2022, was to pay down that debt. Maybe you can just take us through where you stand now and how much debt you paid off. I believe you started with $650 million. Was that correct?
We ended up, we drew a total of $638 million altogether on our line of credit over time. We are down now to about, at the end of the quarter, at 380. So we've tried to be as aggressive as we possibly can on that. Now with the higher commodity prices, that's done, I think, a great job of providing that capital for us to be able to allocate to that. So we really spent 2023 really as aggressively as possible, paying that down, the beginning of 2024 as well, really taking advantage of those higher commodity prices to pay that down. That continues to be our number one capital allocation item. However, we have gone back into that potential share buyback mode as well too. Now, it's not aggressive. We haven't been really strong on it, but we did want to start picking away and look at allocating capital to that, just because we see ourselves, especially at where we think the new kind of baseline commodity price lines are at. We see that as a nice accretive way to do it as well, to pay back our shareholders, is that share buyback program as well too. Again, not as aggressive, nearly as aggressive as we have done at periods of the past, and probably not as aggressive as we might do in the future, because of course, still our number one capital allocation is pay down that debt, make sure we have availability of credit, and make sure we're moving forward in making sure liquidity is available for us if there's additional deals for us to do in the future beyond the Mara project, of course.
So let's talk about the buyback, and the reason why you're doing it is because you are trading at or near your NAV, and you think you represent very good value, and you're trading, when it comes to valuation, you're trading below a lot of your comps. So maybe you can just take us through why Sandstorm is trading at such a big discount to its comps, and also what you and your team are going to do to tighten up that valuation gap.
Yeah, I think there's two main important points. One point has been that debt. That was the biggest comment that we had all through 2023 from institutional shareholders and many retail shareholders as well too, is that, we're at entry and we're in a high interest rate environment. You really need to, we don't want to see levered companies. So that's why we've taken such a strong approach to it. But another important part in terms of valuation is really just this idea of percentage of assets that of your overall net asset value that are in development rather than production. So we've been hovering a little bit over 50%, whereas most of our peer group is in 80% to 90% range of their NAV is producing assets. So a big change for us is just Greenstone alone. So as Greenstone gets into production, that gives us a big hit. In fact, gets us probably up over about 65% of our 65 to 70% of our overall net asset value will be in production at that point. When Platreef gets into production, that puts us up a little bit higher as well too. So that's some of the things that we can look forward to, I think, over 2024, is seeing a re-rate due to the fact that we're just naturally seeing, because we're talking about, that's why it's so important to talk about our future is in construction, is that as these construction projects convert into production projects, all of a sudden you see that natural re-rate happen because a higher level of our NAV is in production. So that's, I think, even though a lot of things aren't changing in 2024, I would argue that some of the biggest changes is something, that threshold that we've never been able to get over for really the last 5 years, is this idea of really having all those big growth projects finally get into that production phase. For us, that's, I think, a huge key part of looking at our value relative to our other peer group.
And just to summarize all that, construction leads to production, which leads to cash flow.
Correct. Yeah. I mean, the story is always about cash flow. Every once in a while, of course, the market really values optionality, but we have that as part of our production as well too, not just from the cash flowing assets, but really that package of, call it 180, 190 other different royalties in the background.
Well, David, that was a great overview and a great update on Sandstorm Gold. And maybe you can just summarize for us what shareholders can expect in terms of news flow in the coming months.
Yeah, listen, I think it's really important to see. We'll be giving the market updates on really how Greenstone produces and gets through its level. As we start seeing updates on other projects, this year we can expect updates on Platreef, in terms of technical updates and timelines. Same thing on the Mara project, a little bit more definition on the timeline for that project as well too. And then Hanmaden as a really kind of projects through. These are all real key assets in our portfolio, but as well too, we'll be keeping the market up to date as to all those different assets that are seeing more and more capital be put into them, and the type of improvements that it's going to make to the overall portfolio that Sandstorm holds on the assets.
Once again, David, thank you.
Thank you so much, Jimmy. Always a pleasure. Thank you so much for having me on the show.
Hi, Rick. Thank you very much for joining us today. How are things in Washington State?
Life is great. Thank you for having me back.
It's always a pleasure. Rick, gold is up over 20% on the year, and there are a few reasons why this is. And the primary one is because of stratospheric inflation that continues to be very resilient. And a big part of this inflation is coming from government spending. The government is currently spending about 26% of GDP, but only taxing 20% of GDP. And all of this spending is keeping the economy afloat, but it's generating record high inflation that just won't go away. How can gold protect investors against government mismanagement like we're currently seeing?
Well, it's very tough for governments to print gold. They can't conjure it into existence. People have tried alchemy for a long time, and not even government seems to be able to counterfeit gold, despite their success in counterfeiting other things. On a more sober note, I think it's worthy to note that the escalation of the gold price that you talk about, whether you talk about it this year, which is to say, up 20%, or if you take it back a little further, what you've seen is that the move in gold price has really occurred with very little retail participation. If you look at the statistics around physical gold ETFs, until about 5 weeks ago, retail investors in the Western world, at least, were dishoarding or selling gold. The strength in gold has been central bank buying. Now, I would agree with your statement that gold traditionally does well in the context of inflation. But what's kicked this gold bull market off, really, I think, is the weaponization of the U.S. dollar. If, as I believe likely, that the follow-through is retail participation on top of continued central bank buying, then I think, Jimmy, you see a real move in the gold price. And that's what I'm anticipating will occur.
So let's talk about the central bank buying in a little more detail. In 2022 and 2023, they acquired approximately 25% of gold production. That's continuing on into 2024. But what are the reasons why the central banks are buying gold so aggressively?
I think it comes to two general things. First is the weaponization of the U.S. dollar. The U.S. government has decided, in their wisdom, by the way, whether or not you agree with U.S. policy, to export U.S. policy to other countries who may have their own agendas. The weaponization of the SWIFT banking system, which is not U.S. property, but the U.S. government has decided to do anyway as a consequence of the fact that it's denominated in U.S. dollars. And further, the theft by the U.S. government of $300 billion worth of Russian holdings of U.S. treasuries. Again, whether or not you agree with Russia's policy or America's reasons to do so, has caused governments around the world who believe that they might come into the sights of the U.S. government. As an example, the Russians, the Chinese, the Indians, the Saudis, to question their holdings of U.S. Treasury securities and their use of the U.S. dollar for international trade. A second problem, I think, is that the arithmetic around U.S. Treasuries has gotten worse and worse and worse. We came through a period really of U.S. dollar hegemony. I would suggest in the period 1982 to 2022, the internationalization of the U.S. dollar and the decline in both nominal and real interest rates were tailwinds for gold. Now, I think that foreign countries in particular that look at the U.S. dollar and look at U.S. treasuries see an instrument which pays them 4.3, 4.5%, I'm talking about the U.S. 10-year, in a currency where, separate and apart from the CPI, they see the purchasing power of the currency decline by 7 or 8% compounded. And so they're stuck with this sort of a conundrum. You invest in an instrument which gives you a negative real rate of return, and you do so while exposing yourself to the risk of the extraterritoriality of U.S. policy. It's a real lousy bargain for those countries. It can't be any surprise that the Chinese, as an example, have reduced their holdings of U.S. treasuries by about 70%, over the last 5 or 6 years. In the first instance, they think that investing in their own economy and in their Belt and Road strategy around the world, yields higher real rates of return than they would if they were invested in U.S. Treasury securities. And they also allow themselves to escape, at least in some sense, the extraterritorial imposition of U.S. policy through the U.S. dollar. So it's no particular mystery as to why foreign holdings of gold have increased and foreign holdings of U.S. treasuries have decreased.
So you made mention of the fact that China reduced its holdings of U.S. treasuries by 70% over the last 5 years?
Correct.
So what would that be in dollars? How many trillion?
I don't. I guess we could work backwards. If my memory serves me correctly, their holdings were 3.3, 3.4 T, and now they're under 1 T. It would appear that the only major country whose treasuries are effectively unchanged has been Japan. And I think for Japan, the reasons for that are twofold, but one of which probably involves their continued efforts to keep the yen cheap relative to the dollar so that they can continue to export items from Japan to the United States, which is to say, in effect, it's an employment strategy or a domestic political strategy for Japan. Well, that isn't necessarily true in other countries.
So that's what central banks are doing now. You made mention of the fact that investors, both institutional and retail investors, are not participating in the purchase of gold or gold equities. Why?
In the last 5 weeks, my evidence comes from the ETF holdings. They have begun to participate. Why they didn't participate before is a matter of conjecture. My conjecture would be that gold is an instrument that reacts to fear. And we've lived through 40 pretty benign years, going back to the beginning of the lowering of the U.S. interest rate in 1992, all the way through 2022. Stock market was up, the bond market was up, there was lots of liquidity. I'm not trying to say there weren't some punctuations, 1987, 2008. We had some pretty dramatic punctuations, but the lessons that we learned as investors in those punctuations were that you'd buy the dips. The truth is that people were pretty optimistic because financial markets were continuing to do well. This reminds me a bit, frankly, of the late 60s and early 70s, when all of the indications of inflation were in the system, but people hadn't experienced it yet. They'd lived through 2 benign decades after the end of World War II. And while people read about inflation, it wasn't until they had sort of 5 years of experience with inflation. It wasn't until they'd seen the price of gas at the pump go from 20 cents a gallon to $1 a gallon, as an example, that they began to internalize the lessons. And I believe that the same process is underway right now. We talk about inflation, we feel inflation, we think about inflation's impact on others, but we've been schooled through 40 years of pretty benign economic climate to be aggressive, not cautious. Now, my belief is that after 3 years or 4 years or 5 years, people will begin to understand the price that they pay for the diminishment of the purchasing power of the dollars that they earn working or in their savings. I suspect that you'll look at the CPI, which suggests that, quote, inflation is moderate at 2.6%. But you'll look at what happens to the basket of goods and services that you purchase that impacts your lifestyle. And you'll say, wait a minute. The purchasing power of my dollars isn't decreasing by 2%. It's decreasing by 7% or 8%. And if you experience that over 5 years, if you watch your rent, as an example, if you were a renter, increase by 6 or 7% compounded. If you watch the cost of a shopping basket full of groceries increase by 100% over 4 years, all of a sudden you come to the same conclusion that retail investors came to in 1972 and 1973, which is to say all is not well. And I think it's that consciousness that really kicks off a market in the metal.
Yeah, I agree with everything you just said 100%. I am really starting to feel the pain of inflation right across, even though the government says, oh, don't worry, we got inflation under control. We got it down to whatever the number is, 2.6 or 3%. Okay. Doesn't matter. The prices were already up from 40 to 50% here in the last 4 years.
And let's talk about one other thing while we're at it, which is to say the probability of increases in the future. I don't want to give you a Canadian number because I don't know it. But in the U.S., the on-balance sheet liabilities of our government exceed $34 trillion. The off-balance sheet liabilities, though, Medicare, Medicaid, Social Security Trust Fund, military pensions, government pensions, all that kind of stuff, exceed, according to the Congressional Budget Office, $100 trillion. And we propose to meet these obligations with a budget that goes further into deficit by $1 trillion every 100 days. Now, how do we get ourselves out of this conundrum? Understanding that America's GDP is under $30 trillion, which is to say our GDP is less than our on-balance sheet liabilities and is 20% of a combination of our on-balance sheet and off-balance sheet liabilities. How do we solve this? Well, they say, tax the rich. Top 1% of Americans have an aggregate net worth of $5.8 trillion. If you stole the entire net worth of the 1% in the United States, you wouldn't have solved the debt. What you would have done is funded, something like 20 months of the deficit. So you got to throw that one out. Well, how about tax everybody else then? Good luck with that. How about curtailing benefits? Let's say to the old guys like me, hey, Rick, you voted yourself a whole bunch of cool benefits for 40 years. You forgot to pay for them. We're not going to give you the money. You follow me? There's a whole bunch of hard choices. And you know what? We faced those hard choices before. Not as hard, but we faced them in the decade of the 70s. We had unsustainably high debts. We couldn't raise taxes. So what did we do? We inflated away the real value of the obligations. The purchasing power of the U.S. dollar over the decade of the 70s declined by 80%. So we didn't renounce the debt in the honest, old-fashioned way by saying, yeah, we owe, but we ain't going to pay. Too bad, too sad. What we did is we made the debt less important relative to the inflated dollars that we took in via taxation. So my suspicion is that the way that we deal with this $130 trillion obligation or series of obligations is that we, in effect, inflate away most of the net present value of the obligation.
Yes, no, there's no way they're going to lift taxes or cut spending, especially during an election year, right? And doing so would be political suicide.
How do they lift taxes enough? There needs to be some money left over for people to live on. There needs to be a little money left over to reinvest to make sure that the sustaining capital in the private sector continues to be strong enough that at least they can continue to tax. Meanwhile, in the United States, before local expenditure and before debt service, government currently consumes almost 40% of GDP. So how much can you raise tax? Particularly, how much can you raise tax relevant to the size of the obligation? Let's say, just for fun, and I don't think it'll happen, but you got around to balancing the U.S. budget, which is to say you didn't increase the deficit anymore. How do you deal with the $34 trillion that you owe the bondholders? How do you deal with the $100 trillion that you owed folks like me for Medicare, Medicaid, and Social Security? Even if we found $3.5 trillion via increased taxation, we've shown arithmetically that can't come from the billionaires because they don't have it. How do you deal with the debt?
So once again, just to summarize everything you said, in this environment where we have stratospheric inflation or never-ending inflation and also never-ending debt, gold is one way to help hedge yourself against government mismanagement.
Certainly not the only way. Warren Buffett showed in the 1970s that if you bought companies that were world dominators and had pricing power and you paid the right price for them, that was another way. And I thought about that a lot. I've come to the not so stunning conclusion that I'm not quite as smart as Warren Buffett is. I am not as good a stock picker as he is, although I think, pretty good. What's available to most people is the instrument that has performed that function over 1,000 years, which is to say gold.
So we spent a lot of time talking about gold and the benefits of gold. It's up over 20% year to date. Silver's doing a little bit better. It's finally above $30 an ounce, touch wood. And it's currently up around 30% on the year, give or take. What are your thoughts on silver, and does it keep going?
Well, you may remember an earlier ill-timed interview with me where I talked about the fact that silver lagged gold. The price momentum had to be established by gold, and then silver would follow through. And I was dumb enough to tell you that might take a year. And I think it took 3 weeks. It still remains a historically observable fact, going back 50 years, that precious metals bull markets are led by gold. When the momentum is established by gold, for whatever reason, and your listeners could speculate for themselves as to why that is, that when silver starts to move, it moves further and faster. I also made the point in that interview that speculators should look at the junior silver stocks, should look at them in particular because they were hated. And the easy money in speculation is buying what's hated and waiting till it becomes less hated. That's occurred in 3 months. I'm not trying to say that all of the easy money has been made, but I'm trying to say that the hate around the junior stocks, the junior silver stocks, has dissipated. I learned 20 years ago from Doug Casey that the market capitalization of the legitimate junior silver stock universe, I'm not talking about all the petty pretenders in the silver space, but the guys with legitimate deposits, the market capitalization of that group of companies is insufficient to hold the capital that comes into the sector. When the generalist investor comes touring into precious metals, and I think you're going to see that if gold continues higher, which I believe it will, and if past is prologue, when silver begins to outpace gold, and the consequence of that is that people who are looking to employ the precious metals narrative crowd into the junior silver stocks. I remember past silver bull markets, and they're truly something to behold. I came into the business in the early 1970s, and I remember vividly Coeur d'Alene silver going from 10 cents a share to $65 a share. I don't know arithmetically what kind of return that is, but it's stupid for 10 years. I didn't participate because I was too young, too dumb, and too broke. But in the next silver bull market, I remember Silver Standard going from 72 cents to $45, Pan American silver going from 50 cents to $40 or $45. These are truly stupid moves if you have the psychological ability to stomach the volatility, and if you have the financial ability to speculate with some amount of money that you can afford to lose if you're wrong. It's worthy to note, by the way, and we've talked about this on your show before too, in all of those multi-baggers that I've enjoyed, I mean, none of them occurred over a long weekend, right? They take 5 years or 6 years to unfold. And in every circumstance, including Pan American and Silver Standard, during some period of time when they ran from below $1 to over $40, they exposed holders to 50% declines in share prices. And you need to be able to stomach that, both financially and psychologically. If you are, it's a very fertile place to speculate. And I suggest that in addition to that, probably now it's a timely place to speculate.
You know, when I hear you talk about silver and the moves that it's had in the past, it reminds me so much of what we're seeing in Bitcoin, because those are the same sort of moves we've seen in Bitcoin. Last year was up 160%. This year it's already up 60% year to date. And but before we got that, I think in 2021, we had a massive pullback. It was down 60 or 70%.
I think Bitcoin is probably a more fertile territory for a market observer like yourself. I think that involves a lot about investor psychology, and I'm not very good at that. I can't even dress myself. I tend to confine myself to topics where I believe that my experience gives me an edge over competitors, and I don't have that edge in cryptocurrencies. I'm not suggesting that they're valueless. I understand conceptually the network effect. I understand the potential ease of transaction, the frictionless cost that could be offered. I understand, too, the anonymity. I just have a difficult time personally understanding some of the value propositions. And I also don't have 45 years watching the crypto market to begin to understand how markets might react to changes in news. So I will leave discussions of the crypto to people who are better market observers than I.
So I got to ask you about silver. Gold has already taken out its all-time high. It's trading at or near its all-time high, but silver is nowhere near. Is this the year we're going to see a massive move in silver and it's going to take out that $50 level?
The truly honest answer is I don't know. I've never understood the importance of things like the gold-silver ratio. Those rules of thumb don't, to me, discuss utility. And I believe that price is a function of utility versus scarcity. And the fact that silver is 16 times more prevalent in the Earth's crust than gold is an example. Or that gold has taken out its old nominal highs. And silver is only at 60% of its old nominal highs. I understand the observation. I'm just not smart enough to understand the relevance, if any. I'm also old enough and smart enough not to lock myself into a time frame like this year. Well, I'm tempted. Here's what I can tell you. When I look at the gold price, people ask me to set a target, and I kind of say I don't have one. What I do have is a belief that for reasons that I understand and reasons that have valid historical context, the preponderance of evidence says that the gold price will go higher and perhaps materially higher. That's probably all people need to know. That's as certain as they're going to really be able to get in life. If you look at the historic relationship then between gold markets and silver markets, it is likely, if past as prologue, that at some point in time in this gold bull market, that silver will move further and faster. It's true, too, if you've observed the last four markets, that when silver establishes price leadership, that the most volatile of all precious metals asset classes is the silver stocks.
So, Rick, I want to ask you about equity valuations now. Mining, as we both know, is an extremely complex business. There's so much to consider, including metallurgy, grade, size, and geopolitics is always a big one. So many elements which can impact a company's profitability. And when you look at Newmont, for example, the world's largest gold producer, it's up about 2% on the year. Okay, at the same time, when gold is up over 20% on the year. Barrick, the world's second largest gold producer, it's actually down 2% on the year. But like I said, gold is up 20% on the year. Why do we have this discrepancy between the physical and what some of these equities are trading at?
Three things, I think. The buyers in the gold market for the last 2 years have been central banks. They buy gold, not gold stocks. So while there's been a motivated buyer on one side of the equation, that motivated buyer, the buyer with the cash, hasn't cared about the other asset class. In the near term, that's probably the most important dynamic at play in the delta between the gold equities and the gold stocks. The second is that although the gold price has increased, and one would expect as a consequence of the product price increasing that the margins would increase, the costs associated with producing an ounce of gold have increased too. The social expense, which is to say taxes, royalties, off-concession expenses, have been increasing at 35 or 40% compounded. The energy costs of mining companies over 4 years have doubled. The labor costs are increasing at about 20% compounded. So the margin increase that you would hope to see as a consequence of a 20% increase in the gold price haven't occurred in the same fashion. And I'm afraid to say that the third reason is the performance of the gold equities during the last major increase in the gold price. If you'll remember back, and I'm sure you do, to the decade 2000 to 2010, in that decade, the gold price increased from about $250 an ounce to, if my memory serves me well, $1,800 or $1,900 an ounce. So you had a seven-fold increase in the gold price. And the free cash flow per share of the XAU fell. It took real skill for the industry to generate declining free cash flows per share when the selling price of their commodity went up sevenfold. Now, I suspect that that problem is, at least for a while, a relic of the past, in the sense that the management teams that presided over that destruction of value were all thanked and excused, allowed to pursue other employment opportunities. And I think that the institutional investors, myself included, have a real memory of that period. And we are looking at the interplay between the income statement and the balance sheets of major mining companies much more rigorously than we did in the past. In other words, I don't think that the managers would be allowed to be that stupid, even if they were predisposed to be that stupid. But I think until you see absolute growth in free cash flow per share on the XAU, that you aren't going to see broad increases in the gold price, in the gold equities that reflect the increase in the gold price. I think that margin expansion is going to occur in 2024, which means I think you will see companies like Barrick and Newmont begin to exhibit the margin increases that you're seeing in companies like Alamos and say Agnico Eagle. And if that happens, it's still an if. If that happens, I think you'll see a real romp in the gold equities. Traditionally, that romp has been led by the largest companies in the space. They have the liquidity to hold the extra money that comes in. But fairly quickly, when the big guys' share prices goes up, which means their cost of capital goes down, if the move doesn't extend to the mid-tiers, what happens is that the market arbitrages that out, which is to say the big companies with lower cost of capital take over the small companies with higher cost of capital. And I suspect that this whole thesis that we've watched historically time and again in the gold equities markets over the last 50 years transpires, beginning slowly, fitfully, in 2024.
So, Rick, let me take the other side of that argument, okay? And let's just say the central banks have been very aggressive in bidding the price up, okay? Do you think the central banks have created an artificial gold price and that maybe the equities are actually factoring the true price? So it's not $2,400, maybe it's $2,000, maybe it's $1,800 an ounce.
If I thought that the U.S. government would cease the extraterritorial imposition of U.S. power on other countries, I'd be partway to a yes. The rest of the yes would require me to believe that the deterioration of the purchasing power of the U.S. dollar was going to abate, which is to say I would have to believe that we would solve the debt and deficit problem, that the United States would have to solve the spending problem, that the United States would once again be able to sell U.S. treasuries to foreigners and not have to counterfeit, quantitatively ease the U.S. dollar. And I don't believe that any of those are true. Because of that, I think that rather than being artificially high, what you have seen is that the foreign central banks were the first leg of buying, the first leg in the arbitrage between gold and U.S. dollar denominated fiat savings products. Well, what other piece of data that I think your listeners might be interested in? I've probably used it on your show before, which is to say gold's market share. The market share of precious metals and precious metals related investments in the U.S. market is about 0.5%, which is to say that less than 0.5% of total savings and investment assets in the United States are precious metals and precious metals related assets. The 4-decade mean market share is 2%. If gold merely reverts to mean, which is what I think is going to happen, demand for the stuff, by stuff I mean both precious metals and precious metals related investments, increases fourfold. And that's exactly what I think is going to happen. Yes, that would be quite a move. Now, let me ask you about, we touched on Bitcoin earlier, okay? But we can't, I'm not going to let you off that easy, okay? Because like I said, Bitcoin's up 60% of the year, gold's up about 20. As you know, Bitcoin, the SEC approved Bitcoin ETFs earlier this year. It took gold ETFs 5 years to get to 5 billion. It took these Bitcoin ETFs 57 days to get to 5 billion in AUM. Right. And do you think there's a lot of investors, I guess, do you think Bitcoin is taking money away from the gold sector? And I think on the margins, I think speculative money, yes. Yeah. If you consider the fact that the estimated net value of global savings and investment assets is about $800 trillion, the market capitalization of gold on the one hand and the market capitalization of Bitcoin on the other hand are, to quote Robert Friedland, two pimples on an elephant's behind. They don't matter in the aggregate. They aren't necessarily competitive with each other. They're competitive in the minds of retail speculators, to be sure. And I think that the allure of Bitcoin speculation has probably made the junior mining sector much less attractive. I don't think from an investment perspective that cryptocurrencies have impacted gold at all. I don't see the Chinese central bank or the Russian central bank or the Iranian central bank being large purchasers of Bitcoin. As far as I know, the only international investor in Bitcoin has been that financial stalwart, El Salvador. But I do think that you see perhaps the disintermediation from the junior gold sector into cryptocurrencies, which is to say the speculative allure of Bitcoin is probably there. I would suggest to you, however, that over the last 20 years, a lot of the speculative capital that might otherwise have gone into the gold sector went into technology, including big tech. The so-called Magnificent Seven, or now Magnificent Seven plus one, I think has attracted a lot of speculative capital. There are a lot of investors in those big technology companies that can't spell the products that they produce. So clearly they're not investors, they're speculators. But they're attracted to the narrative and attracted to the momentum. And I would suggest that a larger cause of the so-called dearth of capital facing the speculative resource sector has been technology and big tech, rather perhaps than crypto, given the relative market capitalization of technology relative to Bitcoin. I'm not diminishing what you say. I think that we have seen very strong performance in the cryptos in the last 5 or 6 years, which I think has caused some of the speculators, some of the so-called volatility worshippers, to go over to Bitcoin.
No, that's an excellent point, because if you go back 10, 12, 14 years ago, so many of the sectors that exist now didn't exist then. If you look at cryptocurrencies, EV, social media stocks, cannabis stocks, I'm probably missing a few, AI now, right? Yep. We have all these new sectors that didn't exist a dozen years ago, and now they are attracting trillions of dollars. So fair point. Right. Rick, as we wrap up, you and your team always have a lot going on in terms of events. Maybe you can tell us about some of the upcoming events.
Well, in terms of the events, my big event is coming up. The Natural Resources Investment Symposium is coming up July 7th through 11th. Your listeners could attend either in person, which would be my preference, in Boca Raton, Florida, or if that's inconvenient, they can attend via live stream from the comfort and convenience of their own home. In either case, we're going to give you about 60 hours of very intense, very valuable programming, more than you could absorb in the 4 days of the conference. So the proceedings will be recorded, and you can and should view those proceedings again and again. Two other points that I think make the conference a standout. The first is that every public company at the conference and every exhibitor has been vetted. At every other conference I know, the qualification for admittance is a check that cashes. At our conference, the shares have to be owned in accounts either owned and managed by myself. No guarantee, sadly, that because I own a stock, it goes up. But there is a guarantee that keeps the promise very honest. And that allows me to make you one other promise. If you come to my conference, either in person or via live stream, and you think that I haven't delivered value for money, that I haven't earned the tuition I charged you, email me. Gold-plated money-back guarantee. The financial risk of this conference is mine alone. In 30 years or so of making this promise, I've had to refund about 0.1% of the tuitions I've charged. But that notwithstanding, unlike any other conference that I know about in the world, I have the absolute confidence to say to my attendees, absolute gold-plated, no questions asked, money-back guarantee.
Well, Rick, that was great. I'm not going to be there in person, but I'm definitely going to watch it online. So once again, I'm looking forward to it. And I want to thank you very much for being with us today.
Well, thank you so much for the opportunity. I enjoy these conversations. You've been in these markets long enough that the questions that you ask me occasionally stump me, which is fun.
Once again, thank you. Did you know we're now on Spotify and Apple Podcasts? So now you can listen to us on Spotify or Apple and listen and learn when you're stuck in traffic on the 401 in Toronto, the I-95 in New York, or the I-5 in LA. So be sure to subscribe and follow us on Spotify and Apple Podcasts. Hi, Shaun. Thank you very much for joining us today. How are things in Toronto?
Yeah, Jimmy, good. Start of summer and looking forward to a good summer ahead, but it's great to see you.
Likewise. So, Shaun, before we do a deep dive on your various assets, why don't we just start with a brief overview of Triple Flag? How many assets are there in their portfolio? How many are producing? And what's the breakdown between gold and silver?
Yeah, we just turned 8. Can you believe it, Jimmy? And there are now 234 assets in the portfolio, very diversified. And really, we've generated the highest ounce growth in the sector in that time since we started. And that's really coming from 32 assets principally. So a lot of growth that we've demonstrated and a lot more with a lot of optionality to come. And so gold and silver, we are very concentrated deliberately in those commodities. We're up just over 90%. So you can think of it about 75, 76% gold, around 20% silver, which with the recent run-up in pricing is obviously being pretty handy. And then the rest is a bit of copper and nickel.
And the other element I want to ask you about your portfolio is country risk. And this is something it's always present in the mining industry, but it seems like it's becoming even more so here in the past year. But maybe you can just speak to how you and your team look at country risk and try to minimize it.
Yeah, it's been very topical lately, as you note. And, for us, firstly, I've had the good fortune of working all around the world in a lot of different mining jurisdictions. When we think of country risk, we think about it quite specifically because you can have a devil of a time trying to permit a mine in parts of the United States or Canada, for example. So I think that the broader regime and the specifics on the social license are very important. But on a high level, we're around 80% concentrated in Australia, North and South America, and traditional mining jurisdictions. That's by design. We've really constructed the portfolio with country risk in mind. Our biggest concentration is Australia, with assets like North Parkes and Fosterville as headliners. And when we go outside of those more mainstream jurisdictions, it's with a very clear focus on the size of the check, the level of security and commercial structure, but primarily the underlying ore body, as well as the quality of the assets and the social license of the operator. And so you'll see a very diversified portfolio from that point of view, and I think a very competitive risk profile.
So that's a good overview of Triple Flag and your portfolio. Now I want to dive deeper in on a couple of your primary assets. The first one is North Parkes. This is your largest asset. It's a large copper mine in Australia, represents approximately 25% of your NAV, and it's been a huge driver of growth for Triple Flag. Maybe you can just speak to what the operator evolution has been doing to drive this growth.
Yeah, so I've had the good fortune of, I'm still a bit jet lagged actually. I got back on the weekend from visiting the site. And as you know, Evolution acquired the asset from CMOC late last year in December. They are well advanced on integration, and there should be an analyst site visit there in a couple of weeks, and they'll be releasing a study on the next big zone, E22, towards the end of June. But you may recall, Jimmy, this is an asset we bought back in 2020. It's a copper mine, but we stream gold and silver. And it's a mine that's been operating for 30 years, which has a visible reserve mine life into the 2050s, but many decades beyond, most likely, with the resources and the grade and the more than 1,000 square kilometer land package that we're exposed to. And so those reserves are only on 26 square kilometers. We did highlight at the end of last year that they were now entering into some high-grade gold zones with some open pits, E31 North, and we've seen that come into book in the first quarter. That'll really affect ounces for us in 24 as well as 25. But you would have seen a quarter-on-quarter increase in gold from North Parkes by about 90%. And that, is, think of it as roughly a doubling of contribution from the asset compared to prior years. So yeah, just a beautiful asset that in the prior 20 years had generated about 1 million ounces of gold and has an incredible mineral endowments and likelihood of reserve replacements over time and expansion potential.
And this is one of the great benefits of being associated with a copper mine is, unlike a gold mine, which might have a mine life of 10 years, these large copper mines could be 50 or 75 years or more.
Yeah, that's right. And the guys on the ground talk about this going on for 100 years. It has multi-ore sources. So I mentioned some of the open pits. They were actually the first fully automated underground mine in the world. They have these cigar-like porphyries, and they were the first, I think, in Australia to successfully do block cave mining. So there's block caves, sub-level caves, as well as open pits, and so you got that beautiful multi-ore source and this cadence of bringing on new ore bodies over time.
And the second asset I want to ask about is Impala Bafokeng. There was a change of ownership in the mine last year. The new operator is implementing a number of optimization projects. Maybe you can just speak to these projects and how they might impact productivity going forward.
Yeah, so RBPlat was, an incredible operator with a great social license. Their primary owners, the Bafokeng, really, this was like their sovereign wealth fund. The asset suffered a bit during a protracted takeover with Northern. It was a battle between Northern and Implats, which really, I think, saw some of their ramp-up deferred. And so I think now that that's resolved with Impala, with their track record, they're one of the leading PGM producers in the world. This is some of the last of the shallow Merensky high-grade ore bodies in the Bushveld Igneous Complex, and has synergies and is well located for Impala. So my expectation is they are going to integrate the asset, get the cost structure in line, and then utilize this platform to really ramp up and maximize the value from that asset as part of their integrated portfolio. We're really, I think, very privileged to have this. This is a multi-decade asset as well. We also provide $100,000 a year scholarship programs to continue to enhance their privilege to operate. But I think you would have seen other competitors do streaming transactions on PGM assets in the same region. Those assets are ramping. This is a really well-advanced, incredible infrastructure, and I'm really happy to have this as part of the portfolio with that operator.
So let's look at your pipeline of growth now in your current portfolio and your guidance for the year. You mentioned this, but it's 105 to 115,000 gold equivalent ounces or GEOs, but you're guiding toward 140,000 within 5 years, which is significantly higher than any of your comps. How exactly will you achieve this growth? And maybe you can also touch on capital deployment.
Yeah, it's, I think the important thing, this is a model that gives top-line exposure, as you know, Jimmy. And it also allows you to achieve a level of diversification and optionality, which you cannot really replicate in a producing portfolio and ETFs. And I think we've seen that over the last 7 or so years. So I've mentioned the growth already, that 20% CAGR. You would have seen, even though we're the youngest of the intermediates and senior streamers at this stage, we've deployed since 2017, our first full year, equivalent capital to sort of the intermediates, and nearly half of that of the two largest peers in the sector. But we've generated 2 to 4 times the amount of growth in actual ounces over this period of time. And so I think the track record piece is employment, as well as being a sensible steward of capital. You'll see we have the highest insider ownership in the space. I hold a lot of shares, as does my senior management team in this company. And that really does drive our focus on growth and value of per share metrics. And to your point, that means not only do you look at ounce growth, but how much money you're spending to generate that growth, and the risk associated with delivery. So you'll see that the proportion of value, even though we've got those 234 assets, you'll see an excess of 70% of the value or the NAV in the portfolio is associated with producing assets, many of which are ramping, like North Parks, like the Stelldrift mine at Bafokeng in Platts, or Impala Bafokeng mine. And so a lot of the growth is associated with that. And as you'd appreciate, the risk profile is different if you are projecting growth from brownfields or existing mines that are ramping up with know-how, capital, and a track record, compared to mines that perhaps have to be permitted, certainly have to be funded, and then have to be constructed or ramped up. You won't see a lot of that in those. So as you think about that growth projection and the delivery to date, I think it's an important feature that investors should appreciate and think of that along with our track record to date.
So far we've been speaking about the producing assets. I want to look at the development assets now, which are 41. Is there 1 or 2 assets in the portfolio that you are most excited for that could lead to a lot of optionality going forward?
There is. I want to preface this by saying, the way we've chosen to compete in this sector is really through these larger, high optionality producing assets. And I've covered a bit of that already. But you'll see we've got over 200 in that non-producer category that over different time horizons are likely, some subset are likely to generate future GEOs. And these are things that aren't currently modeled, I think, by investors or analysts. So a good example in the last quarter is we got a few thousand GEOs, from Kensington, which is a new royalty that has come into production for us with Coeur as operator. Nobody was focusing on that. And I think that's the power of those non-producing assets. But alongside the one I've just mentioned, a lot of these, we've got, for example, Hope Bay with Agnico doing extensive work on that asset. I think they have a study coming out in 2025 or so. They're the right operator for that asset. And, we have a royalty on there. And I really think that'll be, in not too many years from now, a good GEO contributor with a great operator. Kone, we've seen the Lundin family come in for some significant investment there. Martino and Nacisio taking over as CEO. They've just got their environmental permits, and they should be looking to get their construction permits fairly soon. And I think probably in that 26, 27 timeframe, you will likely see that asset be a contributor. You'll see on our website, if you look at the deck that we have, There's a large subset of others in that sort of time frame, that 5-year time frame, which we've highlighted there, plus several beyond. But then spare a thought to there's so many others there that could contribute without further investment, which I think is an important feature of this model.
Shaun, let's look at the deal pipeline right now. I want to get a sense of what's happening out there just in terms of the number of deals that are being shopped and the size of the deals, and if there's more of a focus on gold or silver. What are you seeing?
Yeah, so I think this is an interesting environment for us. I can say quite clearly that at this very minute, we've looked at over 800 opportunities in the last 8 years for the transactions we've done. I think for the first time in some time, we've started to see a return of the things that we prefer to invest in, which are large check producing assets with good land packages, good prospectivity, and good expansion potential. And we're active on several of those. We are also active on the usual array of sort of more tuck-ins, smaller, maybe tens of millions, some producing, some not. You'd appreciate that in a business like this, there's a lot of businesses that really struggle to raise capital. And I think the sector is not being well served through debt and equity capital markets for single asset producers and project developers. So you have to be very thoughtful in your portfolio construction, how much of that you want. We are always looking at a number of those things, and we will occasionally invest in that as well as some longer dated stuff. But with over 200 in that category, that's not a priority. It's more the larger, chunkier assets, either acquisition financing, where we're working alongside the capital providers, or indeed, looking to help miners improve their balance sheets and their liquidity profiles, or for investment in their ore bodies.
And when you speak to large, chunkier assets, which will require a larger check, can you quantify that?
Yeah, our sweet spot when we set out to start, because remember, we weren't spun out or burst with any assets. I built the team, we built our pipeline deal by deal. But we said that we were going to be gold and silver focused primarily, no oil and gas or coal, maybe do a bit of base metals or battery or transition metals in the portfolio. And we would write checks in maybe 1 to 500 million as our preferred part of the histogram. So we've done bigger, other than the M&A deal we did with Mavericks last year, which was over 600 million. The North Parkes stream was the largest this sector's seen in the last 8 years at 550 million. And I think, we've obviously done smaller as well. But when you look at the deal pipeline and our capacity to fund, we've got nearly 700 million of liquidity. We're close to, zero net debt. And we're generating on a trailing basis 50 plus million of free cash flow a quarter. So we have ample firepower. So I think the pipeline we see and our abilities are actually very closely aligned. And when you consider the two largest in this space have committed, since we've been going, around 4 billion of capital each, and only been able to deliver negligible to no growth, I think that shows that we're already in that sort of sweet spot at the size we're at, to be able to continue to grow significantly for some time to come.
You mentioned earlier that your focus is on gold and silver. So currently 75% of the portfolio is gold, 20% is silver. Would you like to increase the silver component?
I'm quite happy with our concentration of silver as well as gold. I think the important thing is between the two of them that we continue to maintain our focus on precious. If you think about it this way, our first transaction was on Cerro Lindo, which was roughly 2 million ounces a year of silver. So our first year in 2017, we were concentrated on one asset with one commodity in silver. And you can see how we've been able to grow diversification, scale, and the portfolio as a whole. So my point being that deals come along when they come along. It's important to stick to your strategy, and I think we've demonstrated that. But we've got plenty of scope to be able to continue to grow both gold and silver, as well as some base metals if we find good deals.
We've seen a lot of consolidation in the mining sector and also the royalty sector here in the last couple of years. Do you expect this trend to continue?
It sort of struck me, Jimmy, I don't know if you saw the NVIDIA results recently. I think just after their quarterly results, within a period of a week, I think they increased their market cap by $350 billion. And in some ways, it highlights the challenge to the mining sector. There's just one of scale and relevance, right? I mean, if one player like that, within such a short period, can put on so much market cap, think what it takes in the mining sector to, as a collective, to approximate that. So I think that's the strongest argument if you're competing for the generalist dollar, is you need relevance and scale. And so, yes, we should have consolidation. We've contributed to it last year, as I mentioned, with Mavericks. We are value focused. So if there are sensible deals either to acquire or be acquired, we're obviously always in the market for that. I do think social barriers and that are often a challenge in the sector, but we should continue to see that. I think just with a strict shareholder lens, there is just natural synergies and good opportunity to continue to grow these businesses over time. So I think there should be.
So you touched on your balance sheet earlier, and you also mentioned your liquidity, but I just want to expand on this. How will you allocate cash flow in the coming year? Will you be focused on buybacks, dividends, or acquisitions?
Yeah, so, again, I think an important feature for us is, in a sector which very often issues equity, dilutes its shareholder base in the process. We're shareholders. We have very high levels of insider ownership. Capital allocation is at the core of how we think about our portfolio and our portfolio management. So part of that starts with paying a dividend. We pay, a sector competitive dividend, which we've grown 5% year on year. That consumes a little over $40 million US a year of cash flow. I mentioned our trailing cash generation run rate of over 50 million, bearing in mind we're growing and commodity prices have been pretty strong of late. So easy to service the dividend, and plenty of firepower to continue to grow. Our highest and best use of our capital continues to be acquisitions in businesses on accretive assets. And, we've demonstrated that, I think, by now over the last 8 years. We're no longer just the new kid on the block. We've been around for some time now. So I suspect, investors should expect to see more of the disciplined growth and capital allocation we demonstrated in building the company today.
Shaun, one of the unique features that separates Triple Flag from its competitors is the relationship with Elliott Investment Management. And for those who are familiar with Elliott, it's a large fund manager based in New York with over $50 billion in assets. But what are the benefits of having Elliott as a partner?
Yeah, it's look, as a private company, they, with their balance sheet, allowed us to compete out the gate with our chosen competitor set, really the big three. And we felt that was the more sophisticated, rational end of the sector, and that's really, I think, what we've experienced. At that time, there were about 29 billion AUM, and we're our sole capital provider. And after going public on the TSX 3 years ago now, we bought an extra 264 million US on, and that took them down outside of management ownership. It was just them as a private business providing capital, but that took them down to about 82%. Now, what we've seen since then, like with the Mavericks transaction, which was a low premium deal that benefited both shareholders with some synergies, that took them down to 62%. And then with the Newmont team doing the Newcrest transaction, they placed their blocks out there, and Elliott actually bought just over 5 million shares as part of that transaction. So that took them to 67. So they haven't sold a share. They've been very supportive. They're very, very value focused. I think actually they're about 65 billion AUM now and just been growing incredibly. And as non-resource investors, they like gold. They love this model. They've been very good investors to us. And I expect them to just be very rational, value focused and patient, because they have no sunset on their capital, unlike a lot of resource funds that perhaps invest in 5 years and exit in 2 or 3.
And I know you can't speak for Elliott, but given that they have this large holding, they must be very bullish on gold.
I think it's well publicized that they're intrinsically mistrustful of central bank money printing. All our governments are running deficits like, it's all going to be something you can keep doing forever. And that's not great from a monetary policy, and just gold has an important place, I think, as a store of value. And so that's been at the core, I think, of their desire to work with us to build the company we've built. They like the exposure, and I expect they'll continue to want some exposure in this environment.
And I want to get your thoughts on what you're hearing from investors. Gold is up over 12% on the year. Silver's up significantly more. And given the current economic backdrop that we find ourselves in, and also the positive returns that we're starting to see in gold and silver, are you getting a lot more inbound calls from investors, both institutional and retail?
I think the short answer is yes. Look, other than visiting North Parks last week, we were marketing in Australia. It's quite clear that on the one hand, as much as the Chinese and others have been investing heavily, central banks, retail in gold exposure, I think in the West, guys are underweight. And I think that really represents an opportunity. I think with the producers, it's only recently that we've seen some of the cost inflation for some level off. So the increase in prices hasn't necessarily translated into margin expansion. And so a number of the investors we've seen have been looking at the top line exposure, the diversification, and the growth that we have offered. And I think over and above, recognize that of the intermediates and seniors, we are one of only 3 that met guidance last year, but we're the only guys to increase guidance this year out of the top 6 in the space. So I think that track record of delivery and ongoing growth has appealed to a number of investors, particularly with the favorable commodity backdrop.
Shaun, as we wrap up, what can investors expect in terms of news flow from Triple Flag in the coming months?
I think we just put out record quarterly earnings again of just nearly 28,000 GEOs underpinning those in Q1. Our focus is on continuing to deliver into yet another year of record growth, eighth year. So there's a big focus on that. We are active on a number of transactions. I'm hoping we'll be able to convert some of those, but we will be disciplined to the final second on each and every one of these things. But I just think in the public eye, the importance of just continuing to be a reliable custodian of shareholder capital, delivering those quarters, delivering growth, and focusing on delivering more sensible transactions while maintaining a sensible balance sheet and continuing to grow a dividend is a large part of what we'll look to deliver for our shareholders in the months and years ahead.
Well, Shaun, that was a great overview and a great update on Triple Flag, and I want to thank you very much for making time for us today.
Jimmy, thank you. It's great chatting to you again.
Hi, Jim. Thanks very much for joining us today.
My pleasure, Jimmy. I'm delighted to be here. It's morning where I am. I guess it's evening where you are.
Jim, I know you're bullish on gold. It's up 15%, give or take, on the year. But Bitcoin, or what some call digital gold, is up significantly more. It's up over 60% on the year. What are your thoughts on Bitcoin's massive outperformance, and is gold a dying asset class?
Well, I wish I'd bought it. Obviously. Well, I've never bought or sold any cryptocurrencies. So they've turned out to, scratch that. Many of them have disappeared and gone to zero. As you know, there were thousands at one time, and they're always cropping up every month. I have never played long or short any of them. Crypto has been a huge success. My view is that if it ever, as a trading vehicle, it's great for whoever knows what they're doing and is trading it. But as I say, many have disappeared, and many Bitcoins have disappeared. I don't know where they go, but somebody steals them or whatever. But if Bitcoin ever becomes successful as a currency, my view is that the governments will outlaw it as a currency, because governments don't want to lose monopoly, don't want to lose control. Again, throughout history, governments don't like other people controlling money, and they will make it illegal. Now, the crypto guys say, we're smarter than the government. Of course they are, but the government's got the guns. The government's got the tanks. money is going to be on the computer, Jimmy. You cannot take a taxi in China with money. You cannot buy an ice cream. The Chinese are way ahead of the rest of us, but every country is now working on computer money, and it's going to be there, but it's going to be government money. It's not going to be your money and mine. And I would also remind you, some countries have already outlawed cryptocurrencies. India. Well, if you're sitting there with all your money in crypto money and the internet's closed, you're in a bit of a bind. So there are shortcomings for cryptocurrencies as well, and not just government actions, the world.
So I guess that makes a good case for gold and hiding it under your bed.
Well, I own gold and silver. I would rather buy silver than gold right now because it's cheaper on a historic basis. But Jimmy, I'm an old peasant. You know, all of these politicians and academics say, forget gold, it's obsolete. Maybe, but us old peasants want to have some gold in the closet or under the bed when things go wrong. And so I presume that enough old peasants like me who will continue to buy gold and silver in case.
And I'm glad you brought that up, Jim. That leads me to my next question. Bitcoin was up 160% in 2023. As I mentioned earlier, it's up over 60% year to date. Gold's doing okay. It's at or near all-time highs. But with all this geopolitical risk happening throughout the world, with inflation at 40-year highs, record high debt levels, why isn't gold at $3,000 or higher?
Well, I'm a little surprised that gold is up almost 100% in the last 18 months. I don't consider that languishing. For those, silver's up more than 100% in the last 18 months. Yes, and compared to Tesla, compared to Bitcoin, of course it's not up as much. But I hardly consider 100% a languish in 18 months. But the answer to your question is, of course, there are many other things that are hotter and more exciting right now for many people. And I mean, what's the thing that was last week? GameStop, whatever that thing was called, where they had the short squeeze. It's much more exciting than boring old gold.
Jim, you just mentioned that you prefer silver over gold. Why?
Well, silver's down 45% from its all-time high. Gold is 10% from its all-time high. On a comparative, historic basis anyway, silver is much cheaper. And silver has many uses. I mean, solar energy, apparently solar energy is getting bigger and bigger. You know, you need silver and many things. So silver is just cheaper. But if it were reversed, if gold was down 45% and silver down 10%, I'd say buy gold. Buy both, but more silver.
So silver is trading around $30 an ounce. The all-time high is $50 an ounce. Are you a buyer of silver at these levels?
No, I'm waiting. There's a correction going on. You know, India is a huge market for gold and silver, and a lot of those people are, for a variety of reasons, are having troubles right now, so liquidating their gold and silver. But who knows? My timing is very bad. I told you, I wish I could time like Roy Neuberger could. I'll buy more gold and silver somewhere. I just don't know when.
Maybe the Indians are selling their gold and buying Bitcoin.
Maybe they are, and if so, hooray, 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 except India has made Bitcoin illegal. So, you know, they're brave Indians if they're doing that. I should say India has made cryptocurrencies illegal, not just Bitcoin.
Yeah. Jim, one of the other things that really stands out to me is that there are many well-known investors who are advocating for Bitcoin, Michael Novogratz, Michael Saylor, Paul Tudor Jones, but we really don't have anyone like that supporting the case for gold. What are your thoughts on that?
So what? I mean, yeah, Bitcoin has been a great success as a trading vehicle. There's no question about that. You know, some of the people you mentioned, I mean, at least Paul, you know, Paul's a fantastic trader. Paul is probably as good as, maybe better than Roy Neuberger was, because he's more multifaceted. But I mean, it doesn't. So what? I'll never be as good a trader as Paul Tudor Jones. or Roy Neuberger. And if they find great trading vehicles, do it. Don't listen to me. But you ask about it. I'm just suggesting to you that if Bitcoin and the others become successful as money, they will be outlawed. But if they just continue as trading vehicles, as long as people can make money trading something, history would indicate they'll keep trading it. Most things, though, that people have traded constantly and forever have had ultimately some economic use. I mean, the Mississippi bubble, 300 or 400 years ago, at least theoretically, there was land in the South Seas that you could speculate in. The tulip bubble, at least theoretically, you could take your bulbs and plant them and have tulips. So most things that have become great trading vehicles have eventually disappeared if that's all they were. But maybe Bitcoin is going to go on forever, and cryptos as trading vehicles. As I say, if they become successful as money, I suspect governments are already starting to outlaw them. And Jimmy, governments are all working on crypto money, computer money. As I said, in China, you can't take a taxi with money. They don't. I tried to buy an ice cream in Beijing. A woman couldn't say, she'd never seen money. She was 19 years old or something. She gave it to me, the ice cream, in the end, because she didn't know what to do with money. I mean, now I have, even I have money on my phone now, but it's government money. It's not crypto money.
Well, Jim, maybe then next time we speak again in 6 months or so, you might have a digital wallet with some Bitcoin in it.
Well, I have a digital wallet in the sense that I have money on my phone, as I say, but it's money which is governments recognize, not which governments say is illegal. I mean, I want to repeat, in India, cryptocurrency is illegal. Only 1 billion people in India. China, it's illegal. 1.4 billion. So in Myanmar, they close the internet. What do you do if all your money's on your phone and the computer's closed? Texas, electricity went down. What do you do if you're in Texas and there's no electricity and all your money is on is crypto money? I mean, maybe you have an answer. I don't know. I wouldn't have. I don't know. If I needed to go down to the shop and buy some bread and the electricity was down, I wouldn't have any money.
Well, I guess you wouldn't be eating very much.
I know I wouldn't be eating. I can go in there. I can say to the guy, my money's here in my phone. He'd say, I'm sorry, sir. I need money in my cash register.
That's a very good point, Jim. What do you do if the power goes out? But like you said, you can't hold it in your hand and you can't buy anything with it.
Well, even if you couldn't hold gold in your hand, gold does have an economic purpose. I mean, it also has speculative purposes and it has jewelry purposes, but gold is also used in electronics, etc., as is silver. So even if women and men all of a sudden decide, I can't stand gold jewelry, at least gold still has an economic purpose. Likewise, silver, as I said, solar panels. Silver kills bacteria. There are many uses for silver besides speculative purposes. I hope it doesn't disappear as speculative purpose because I own a fair amount of it. But even if it does, at least I can sell it to the solar energy guys and the the electric vehicle guys. They need silver.
Jim, copper has also had a big move here in the last few months. What are your thoughts on copper? Do you like it?
Well, as I look around, commodities are the cheapest asset class. Bonds are in bubbles. Many stocks are forming bubbles, property forming bubbles. Commodities are still, silver's down 45% from its all-time highs. Sugar's down about 70% from its all-time high. Commodities are the cheapest asset class, and copper's certainly gone up. It's at a 7 or 8 year high. 7 or 8 year high. The Japanese stock market's at a 31-year high. And if electric vehicles are coming, which apparently they are, electric cars use 5 times as much copper as regular cars. Electric cars use a huge amount of metals, you know, and in fact, for what it's worth, electric cars have a horrible environmental footprint because they have all this lithium and copper and other stuff which has to be mined. And of course, you have to make electricity from something, but people don't really think about that. They just say electric cars are environmentally better than petrol cars, gasoline cars.
And lately, uranium has been performing very well. What are your thoughts on uranium?
I own some uranium just because it got so unbelievably cheap. And uranium, speaking of environmentally friendly, uranium is very environmentally friendly unless it blows up, you know. But if you manage uranium energy sources properly, it's cleaner, cheaper, and everything else than certainly than gasoline and coal. So no, I own uranium, and I think America recently passed a law saying they were going to build uranium stockpiles. I mean, various things are going on to make uranium more attractive.
And China is also making a massive push toward nuclear energy.
Well, as I said, uranium is cleaner than just about anything else, and certainly more long-lasting than most things. So yes, the Chinese are building huge numbers of nuclear power plants. But again, I mean, Jimmy, if your power plant blows up, it's not fun. But if somehow you can manage it properly, and the history of nuclear energy is, of course, it has been extremely safe. We can all name 3 or 4 examples where it was a disaster, but 3 or 4 out of the last 100 years, compared to what has happened, it's not such a bad record.
So you're bullish on copper, you're bullish on uranium, and you're very bullish on gold and silver.
Well, I own them, but you know, I'm not suggesting you run out and buy them today. You should ask Bloor Street Capital about short-term investing. Don't ask me.
Well, Jim, that was a great discussion, and I want to thank you very much for spending time with us today and joining us all the way from Singapore.
Been my pleasure, Jimmy. Let's do it again sometime.
Well, that brings us to the end of another conference, and I want to thank you very much for spending time with us today. If you weren't able to watch this conference in its entirety, you can check it out anytime you want on our YouTube channel, Bloor Street Capital, along with many other interviews. Don't forget to subscribe to our channel and also hit that notification button to be kept up to date on upcoming interviews. We have some amazing content coming out here in the next few weeks, all of which will help you navigate these financial markets. Once again, thank you for spending time with us today.